Okay, try this cozy 4-bedroom Victorian in quiet residential neighborhood, all original hardwood and fixtures. They can move in. Just wrote that.
After several weeks of shadowing Brent, our realtor, through every aspect of his business and personal life, he became noticeably more comfortable in front of my camera. Brent began to really open up, affording us a true insider's look at the business of realty. Eventually, he allowed us to peer inside the cornerstone of his career, the open house.
I always prep for an open the same way every time. Hey, call me superstitious. You got to feel comfortable about the house you're showing. You got to make it feel like you're selling your own home.
Slow down, you move too fast. You got to make your morning last. Just kicking down the cobblestones, looking for fun and feeling groovy.
Tricks of the trade: do not try and do an open on an empty stomach. It doesn't work.
Hello, lamppost, what you knowin'? I come to watch your flowers growing.
That comfortable, hey, it's my place feeling really comes across to buyers. No, I try and get a good night's sleep beforehand. If not,
no deeds to do, no promises to keep. I'm dappled and drowsy and ready to sleep. Let the morning time drop all its pillows on me. Life, I love you.
It's not always location, location, location. When you think about it, it's appearance, presentation, location, location, location.
Talk about making yourself comfortable at an open house.
Oh boy. We've been working with Brent now for a couple of months. He's shown us probably 30, 35 homes. We're not even sure if we're going to buy anything, but that's kind of the way it is. And Brent is just super about it.
You know what? That is, there's a lot of truth in that. You got to be careful when you're selecting when you're working with buyers. You have to spend a little more time up front interviewing them, then do a little more time researching properties for them. But you got to find out from them by asking them upfront direct questions. You know, have you been pre-approved for a mortgage yet? You need to get a copy of that pre-approval. Maybe get them pre-approved through somebody you know if it's a no-named company you never heard of. And also ask them, if we find you a home, are you ready to put an offer in on it? Sometimes you get people, they go house shopping, but they're not actually looking to buy a home, or looking to buy a home anytime in the near future, but like, oh, a year or two down the road, which looking for homes now is just a waste of your time. I don't know why people do it, but they do.
Well, I tell you, talk about a downside of the business, and this is it right here. These little twerps, these looky-loos, these people want to take up your time and they don't want to buy. And I mean, know what you want to do. I mean, it's such a waste of my time. I can't believe it. I'm not here to make friends. I'm here to make friends, business friends. My friends buy from me.
Oh, if you're asking me to use one word to describe Brent, it's got to be sincerity. Just really trustworthy too. If you're going to describe an honest guy, it's got to be Brent. Friendly. Boy, he's a friendly guy, especially to my wife.
That ain't right. Anyway, that's a big goof email, obviously, or the video there. So the realtor and the open house. Don't be Brent, okay? All right.
Okay.
On our Facebook page, I got a video like that teaching you how to negotiate. You'll get a trip out of that one. Guy negotiates with a dentist. Watch that one. You'll get a kick out of it. All right, can everybody see the slideshow in front of them?
Victor, can I ask you a question before we start?
Sure can.
So we're all probably planning on taking the test sometime in the near future.
Yeah.
What would your suggestion be for us in terms of like when we finish this class, which might be tomorrow or Wednesday, maybe? I'm not sure.
Yeah, it's
Like,
not gonna go past that.
So would you suggest that we just like go over like all the material and the recordings of things and practice testing and stuff like that?
Review your notes, your highlights, or the slideshows, whatever you are using, because different people study different ways. So I'm not sure what method you guys are using, but the highlights are good to copy over into your own notebook, perhaps. The slideshows, the ones that had those good slideshows that had all the condensed and better explanations on them, maybe copy them over into your own notes. And by doing that, you're reading it, processing it in your mind, rewriting it again, and it's actually a good way to study by reorganizing your notes. You know, it is a really good way to try to study that way. I do also have an audio recording I sent to you guys. It's a little bit older, but it's still the majority of the information is relevant. About where I'm asking, you know, how I do the question and answer sessions with you guys. I got about a 5.5, 6 hour session like that. Just asking questions and getting feedback. Okay, so you know, you could pretend that you're in that classroom, you know, listening to me. You know, I ask a question, you know, you could pause it if you don't want to get the answer right away, you know. And I ask a question, see if you can get the answer, play it again, and hear what I got to say, you know. It's a lot of students gave me feedback that they actually kind of like that. So that's why I posted it, you know. I created it and I posted it, you know. So hopefully one of these days I'll be able to do it again with the class, you know, but it's kind of hard enough as it is to get through all the content without having an extra day to do it, you know?
Yeah, I understand. And do you recommend, like, I've heard teachers in the past share, like, if you absolutely don't know what the answer is, then like C is always your best bet. Like, do you have a advice on that? Like,
no, these tests are generated at random, and basically I got a database of questions in there, and it's set to draw up the questions in a random order for everybody too. Like you could have two people sitting next to each other taking the exam on the computer. You're gonna get different. You're gonna get different questions and different orders, and you know, it don't. So C doesn't matter.
Right. And then I guess I have one more question. I have an option to take it in the testing center in New Jersey.
Yep.
And I think I already signed up.
Whatever you're most comfortable. Whatever you're most comfortable doing. You can always,
because you can do it at home too, but like, okay, I'm going to take it in on site. Okay, cool. Thanks.
All right. Okay. All right. Yeah. All right. So we left off with, I gave you a bunch of portfolio lenders to start off your contact manager there with. You know, when you have clients that are having difficulty getting lending, not because they have bad credit or anything like that, but because they don't fit a certain lending criteria of a lender. And that lending criteria is usually made up by an investor who's willing to buy the loan from them afterwards when they try to resell it, right? So you could go directly to a portfolio lender who lends their own money, who's not going by any stringent guideline of some third party that they're planning on reselling the loan to. They actually lend their own money. So these people are a little more flexible in their lending. We call them portfolio lenders, right? Okay, so FHA loans. What is an FHA loan? Let me see. Where did we leave off? Okay. Top page 244. Do you have anything highlighted on page 244 right now?
No.
Okay. So we're starting off here then with FHA loans. All right. So we're on page 244 at the top. Let's highlight that the Federal Housing Administration, FHA, and then go to the line immediately below it to continue your highlighting. And we're going to highlight neither builds homes nor lends money. Rather, it insures loans on real property made by the lending institutions. Then go to the line below it and highlight it does insure the lender against loss. And then go to the line below it and highlight a loan that is not made by the agency but insured by it. Pretty much repeats itself twice there. Okay, so does the FHA loan money? No, they do not. They tell your local lender, here are the lending criteria for FHA loans. If the borrower and the property that they are purchasing fit our lending criteria, loan them your money, and in the event that they default, we'll insure you. We'll give you insurance against loss. We'll insure the entire loan. Okay? That's what the FHA does. So the FHA, however, does have lending limits. If you see the slideshow over here, the FHA New Jersey loan limits by county. All right, so I got a couple of links here for you for approved condo complexes. And look, if the condo complex that somebody's trying to obtain financing for does not have, they're not on this approved list, they can always get approved, okay? They'd have to have the management and the owner fill out an application to try to get the complex approved. And then buyers could get the, what do you call it, financing for it. So the FHA New Jersey loan limits by county. Let's take a look at them. Because different counties have different value homes. FHA does have lending limits for how much they'll lend for a 1, 2, 3, or 4 family home. And so what I'm going to do is, you can see the website here. This is the HUD's website for the FHA loan limits. You see HUD.gov. All right. There is no website, FHA.gov or FHA.com. That's probably some mortgage company or some scam site. Okay. There is no HUD.com. Oh, I'm sorry, FHA.com. It's HUD.gov. FHA's going through HUD website. So let's look up New Jersey on the drop-down list. And I'm just going to search New Jersey for this year period. And you see the FHA's lending limits for all 21 counties in New Jersey for 1 family, 2 family, 3 family, and 4 family. They tell you what the median home sale price is in that town. And then, let's see, at Atlantic County, Bergen, you see all the different counties. Let's see, Middlesex County, for a 1 family home, they'll lend up to $765,000, 2 family up to $980,000, 3 family up to almost $2 million. And for a 4 family, 1.4. Wow, that's a lot. Right, so they got some pretty generous guidelines, but you get some cheaper counties like Atlantic over here. For a 1 family, they'll only lend up to $331, 2 family, $424, 3 family, 4 family. So FHA does have lending limits on how much they will allow a borrower to borrow for 1, 2, 3, 4 families, depending on the county that you live in. All right, so you could go here. I got that link available to you guys so that you guys can see it as well. All right, that's right here at the bottom of this slideshow. Okay, so let's see. Most FHA loans are okay. Process. Why does anybody get an FHA loan instead of a conventional?
The low minimum down payment.
That's it. So on the next paragraph, we're just going to highlight that on the next to last line there. They require low down payment. Just highlight that. How much is that down payment? 3.5%. So where it says they require low down payment, after you highlight that, write 3.5% down there below that.
Where does it say the payment? I'm looking for it.
Second paragraph, next to last line, right in the middle, it says they require low down payment. Just highlight those words.
Got it.
And then below it, write 3.5%. It only requires 3.5% down payment, right?
Yeah.
Okay. Next paragraph, because it's all broken up here, these criteria, but the most widely used FHA mortgage is the FHA 203B program that they have, which may be placed on 1 to 4 family residences. I like that. Now, all of these different things that we're highlighting in different paragraphs here, I got them all on this one slide, or pretty much most of that stuff written out here on one slide. So you could also just study this slide, right?
Awesome.
So the following paragraph, we're going to highlight that FHA requires an upfront single mortgage insurance premium, MIP, is charged at closing. This is not PMI. What is PMI insurance? It's when the borrower is putting less than 20% down.
And it covers the other.
It covers whatever the less amount of the 20% that the borrower didn't put down, right?
Yeah.
So this is not that. This is MIP. The MIP insurance on an FHA loan insures the entire loan. So if the borrower defaults, the lender gets paid back every penny. Right? So so check this out. Let me continue reading. You don't have to highlight the rest. It says it may be paid in cash or added into the loan. All right, so wait a minute. This upfront insurance premium, it could be paid upfront, but it doesn't need to be. It could just be added into the loan. Okay. And for a 30-year mortgage, this lump sum premium is 1.75% of the loan amount. Now, in addition to being an upfront insurance premium, there's also a monthly premium that is added in, a monthly payment for the insurance that is continuously paid on the loan too. Now, highlight the FHA may also allow any or all of the down payment and closing costs to be a gift, not a loan, from the borrower's relatives. A gift, not a loan. Because if it was a loan, they would have to factor that into your qualification. It would affect your debt to income ratio, right? Now, in addition, the willing seller may pay points for or furnish money to establish the escrow account for the buyer for the payment for the future property taxes and insurance premiums. They call that the seller's contribution or a seller's concession. Let's highlight a seller's concession may not exceed 6% of the loan amount. So what's the maximum seller concession allowed for an FHA loan?
6%.
6%. Yeah, I just got that.
And that's on the loan amount, not the sale price, right?
Correct.
Because that's what I always get confused.
I'm in the same boat with you. Sometimes I mix it up myself.
Yeah.
6% loan amount. Mm-hmm. Okay. In addition to the lump sum payment, FHA borrowers also pay as much as 1.55% a year as additional mortgage insurance premium in some cases, depending on the amount of the down payment that they made when they purchased the property. The FHA requires that most borrowers, those who make less than a 10% down payment, continue to pay annual premiums for the life of the loan. Wait, what? Yeah, okay, here, let's work it out this way. The only way to cancel the MIP mortgage insurance premium is to pay off the loan or to refinance it. What did they just say? What does that mean? It means that the MIP insurance that insures the loan can never be dropped. Okay, unless you put down at least 10% at the time that you purchased it. But why do most people get an FHA loan?
Low down payment.
The low down payment.
Only requires 3.5% down. So what do you think most people put down?
3.5%.
So then they can never drop the mortgage insurance premium. Now I have a notation here because the book didn't fully say it. They just led on to it a little bit here. They said the realist, what did they say? They said that the FHA requires most borrowers, those who make less than a 10% down payment. So basically they're telling you, if at the time you purchased the property, you put down at least 10% when the loan was originated, you can drop the mortgage insurance premium when equity reaches 78% of the loan, but only after 11 years. Now, previously, there was no minimum down payment requirement on this in order to be able to drop the loan. And this 11 years used to be, I think, 5 years. But either way, it was still 78% equity. That means that you paid off most of the house already. All right. Now, President Obama made this change before he left office. Why did he do this? Anybody can guess? The FHA loan program is used for more than half the loans that are out there. And a lot of them were defaulting. That insurance premiums, in order to pay off the lenders for people who are defaulting on loans, it got depleted completely. As a matter of fact, they had to do 2 government bailouts to replenish it. So he changed the requirements on the loan. He jacked up the amount of insurance premium that borrowers had to pay. And then he also raised he put in this requirement that the borrower had to put down at least 10% at the time that they get the loan and have it for at least 11 years. Otherwise, they could never drop the insurance on the FHA loan. Why did he do that? He did it to make the FHA loan program appealing for people to get into the home, to use the program to buy a property, but to be unappealing and get off the loan as soon as you can. He doesn't want people staying on the FHA program for the long term, because if they default, which they may, then the government will be on the hook for paying back those banks. That's why he did it. And he raised the insurance premium because so many of these loans were being defaulted on that, well, they got to collect the money somehow to put into that fund to pay banks when borrowers default. All right. Just to give you a better understanding how it works. Did anybody watch that movie over the weekend at all or no? Anybody get a chance?
I
No?
wanted to.
All right.
No.
I started, but I didn't.
Yeah, I
didn't get
started
to.
too.
Okay.
I have a quick question.
Sure.
So if we do an FHA loan and we have to pay the 1.5% with the insurance, and then we change to a conventional loan, do we still have to pay the insurance?
No, not if you have at least 20% equity on conventional loans. You have to carry, the only insurance you have is not for the entire loan, it's just for the down payment amount. And if you have 20% equity in the property, at least, you don't have to carry PMI.
Okay. So is that like a loophole where we could put 3.5% originally and then a year later just turn it into a conventional loan?
I don't know.
Like-
You can have 20% equity in a year.
Oh, right. Actually, right.
Right. So it depends. So it goes based off of equity. All right.
Gotcha.
So yeah, but you got the right drift of it, the right gist of it, where you get the FHA loan because it requires low down payment. You get into the program, you're gonna be paying this insurance premium. But after you have the loan long enough where you could build up 20% equity, then refinance to a conventional loan and get off the FHA program.
Gotcha.
Okay. So any or all the down payment and closing costs must be a gift, not a loan from the family's relatives, or not must be, but could be a gift. Actually, must be. Payment and closing costs may be a gift, not a loan from the relatives. Okay, we already did that. Okay. All right. So, I mean, if in that last paragraph that we read about the amount of money to put down, I mean, they didn't go over all those details, but I'm not sure if you're going to get them on exam. So the book doesn't cover it exactly. The wording is not exactly great on that and that clear on that. So at the end of that paragraph, I would write, if equity reaches 78%, if the buyer put down 10%, they can drop the loan after, they could drop the insurance after 11 years. If the buyer put down at least 10%, they could drop the insurance premium after 11 years once equity reaches 78%. You know, find your way to word it, but those three things in there. Once
Is that going to be on the exam?
It may be. It usually is a
Really?
question about when can the insurance be dropped on an FHA loan when equity reaches 78%. But they put a couple of changes in that, you know, saying that it can never be dropped, but it could never be dropped when? Only if you didn't put down 10% when you got the loan. So it's a matter of, I want to make sure you understand it. So I want to make sure it's clear to you in your notes, you know.
So you said,
Yeah.
I'm sorry, you said if equity reaches 78%, they can drop the FHA loan.
No, they could drop the insurance on the loan.
Oh, the insurance, okay.
But only after they had the loan for at least 11 years. And only if they put down 10%, at least 10% when they got it.
That's
So
a lot to remember.
Well, here, no, just write this. No, just write this. MIP can be dropped when equity reaches 78%. Only after 11 years. If the buyer put down 10% or more.
Right.
That's like a lot.
It's not that much.
For one question to be wrong. It's like.
Three criteria.
Right.
When equity, look at it this way. When can PMI be dropped on a conventional loan?
After 20%.
And when must it be dropped?
22.
22.
Okay, this is the reverse. If you have 22% to pay off still, you're at 78% equity, right?
Yeah, it is the opposite. It just makes it a little bit more confusing because they're.
Yeah, but you could try to remember it now. You know, it's the opposite of the conventional. Conventional, it must be dropped when equity reaches 22%. All right, but on the FHA loan, when you have 22% of equity left to pay, or 22% of the loan to pay, that's when it can be dropped.
That's funny.
Hopefully that helps. I don't know.
Yeah.
Let me know when you guys are done writing a note on that.
Got it.
I'm sorry, can you repeat that again, sir?
Okay, so you're gonna write in there that the MIP insurance can be dropped when equity reaches 78%. After 11 years. If the buyer put down at least 10%.
So the MIP insurance can be dropped when equity reaches 78% after 11 years if the buyer puts down 10%.
Correct. If they didn't put down at least 10% at the time that they got the loan, which most people don't, most people put down only 3.5% or maybe 5%, then the insurance can never be dropped for the life of the loan. It would make more sense for you when equity reaches 20% just to refinance into a conventional loan and not pay any insurance on the loan. Right? Everybody got that? Can we move along? Mosey along?
Mhm.
Yes.
All right. So, whoa, we're stay on that FHA loan here. An estimate of value. Go to the second paragraph and highlight FHA allows down payments as low as 3.5%. Now, even though it says here in the book that the FHA will consider applicants with credit scores as low as 620, the FHA does not have a minimum credit score requirement, period. They have no credit requirement. It's the lender that has the credit score requirement. The lender that says if you don't have at least 620, because anything below 620 is considered subprime. But I've had people get FHA loans as low as 580 credit scores. But when they do that, they're going to a lender that's making risky loans. And if they're giving those types of loans to people, they usually want them to put more money down at the time they get the loan. They're probably charging them application fees to get money out of them some other ways, you know. And because they know that this person can't get a loan otherwise. Because what reputable lender is going to be giving them loans with such a low credit score? So those people's options are limited. So they'll go to somebody, they'll say, you know what, we'll put our neck on the line and give you the loan. Now, what do I mean by we'll put our neck on the line and give you a loan? Well, you know, lenders, in order for them to lend you money, they need to be licensed with the Department of Banking and Insurance. And the government can pull banks' licenses, lenders' licenses, if they write too many bad loans. In other words, if people are defaulting on the loans because the lender did a bad job trying to determine and analyze the risk of that borrower, and they write too many defaulting loans, they could lose their license. So if a lender has too many bad loans on their books, the oversight of the government, the regulators, can yank their licenses. But check this out. You know, there are lenders out there that write many bad loans that end up defaulting. How do they still have their licenses? Because they don't keep them on their books. They originate the loan and then they resell them. And what they do is they package up hundreds of loans. Some are bad defaulting loans, some of them are good loans, and they put them in a package and they sell that package of hundreds of loans, if not thousands of loans, to an investor who will buy them all. Now, if you were an investor, would you buy a bunch of bad loans?
Yes.
You would buy a bunch of bad loans? Why?
To get the what is that? Oh my God, I can't get the word.
Hold on a second. You're maybe trying to rationalize it. Here, let's look at it for a second. Say that I lent money to most of the people in this class, and they signed a certificate saying that they would be on the hook to pay me back. And just about everybody's not paying me back. And I were to sell you their loans, would you buy their loans from me? None of them are paying it back.
No.
Well, isn't that like when you go to like an auction?
No, you got a bunch of people with loans that are not, they call it non-performing. They're not paying it back. They're non-performing. They're not doing what they were supposed to do. They're not paying back the loans. Would you buy those loans from me? And,
Well, then,
and then you're responsible for trying to collect on them. No, they're bad no, they're bad loans, right? Well, how could I entice you to buy them? Maybe if I package up enough good performing loans that the juice would be worth the squeeze. And then you would be able to, you would buy that package of loans that has a bunch of bad loans in it because it also has a bunch of good loans that are just enough to make it worth it for you. That's how lenders get the bad loans off their books, and they can continue in the banking business. They package them up with enough good loans to entice an investor to take them off their hands. And both, we could continue making bad loans, even though it's not their goal to make bad loans. It's just sometimes people don't pay back their loans. They don't do what they're supposed to do. And this was incentivized by the government after a while. I don't know if you guys remember, before the mortgage meltdown, we had that market started really spiking. Prices were going up like crazy. The real estate market was getting nutty. There weren't enough homes out there for buyers to buy. People were getting loans left and right. People were buying homes. Why were prices going up so much? Because regulators, or one particular regulator, the guy in charge of all the regulators within the government, a guy named Barney Frank, I don't know if anybody remembers that name. They introduced later on some legislation called the Dodd-Frank bill. But anyway, Barney Frank, he was in charge of the regulators in the banking industry, and he told them, listen, banks are not writing enough loans to poor people and minorities. Answer that for me, regulators. And the regulators, they're just the ones that look over the numbers in the books of the banks to make sure they're doing their business properly and not writing too many bad loans and all that stuff. Otherwise, they'll yank their licenses or fine them or make sure they're not doing anything illegal, right? That's what the regulators' jobs are. So the regulators are like, well, we don't look at these things. We look at they base the loans based off of the risk involved, based off of debt to income ratio and credit scores. They can't take those things into consideration. It's actually against the law for them to take those things into consideration. As far as low income, well, that makes sense because it's based on the debt to income ratio and their credit scores. And if they don't meet the criteria, if they're not within the certain boundaries of the criteria, then they could get less of a loan. And if homes are going for higher amounts, then people aren't going to, sell their homes to them, so people need to qualify for larger loans. I mean, these could be factors why they're not getting them, why they're not getting them, and he's like, as far as race goes, we don't lend to people. We don't have a criteria for. There is no criteria. As a matter of fact, banks are not supposed to look at that stuff. They're only supposed to look at the credit scores and debt to income ratios. They look at the financials. So Barney Frank, a politician, just trying to, make statements of grandeur and get the, little clips, what politicians do. They try to get little clips that they could play in their re-election campaigns, looking for these little verbal clips. And he says, listen, if you don't make more loans, well, not the regulators, but the banks, he said, if the banks are not making more loans to minorities and poor people, then they've got to be involved in discriminatory activities, and we're going to start yanking their licenses and fining them tremendously. And the regulator said, yeah, but it's based off of the lending criteria for the debt to income ratio and stuff. If they don't fall within the lending criteria, they're not going to get the loans. Well, that should be irrelevant. Now, bankers started saying, wait a minute, let's get this right. You're telling us that even though there's regulations based on, debt to income ratios, and we look at the numbers to determine whether somebody is a worthy credit risk to lend money to, you're telling us that despite those factors, if we're not lending more money to people that are poor or minorities, that you're going to fine us heavily or yank our licenses? But we know that a lot of these loans are going to default. He said, I don't care. Everybody should have an opportunity to experience the American dream and get involved in housing. So you have to write more loans to these people. And the banks are like, so you're telling us to write more loans to poor people and minorities specifically, otherwise you're going to fine us or yank our licenses. Boom. Now that opened the floodgates for the banks to get involved in what became known as predatory lending, where now they're specifically targeting minorities and low-income persons who they already know are more likely to default on loans. Not minorities, but the low-income persons are more likely to default on loans, because if you look at the numbers, as it is, they can't afford to pay it back. So you already know if you're going to lend this person money, there's a higher risk that they're probably going to default on the loan. And sure enough, they eventually did. But it's when the politicians got involved and started doing this bullshit, about political, well, you need to lend to more minorities and low-income persons. Otherwise, so banks are like, okay, we'll lend to them. No problem. We still make money, and they started doing that. And now by lowering the lending criteria. So if you lower the lending criteria in, the qualifications in order to qualify for a loan, so that poorer people can now afford to borrow that money, which they previously would not qualify for. That's how they're able to end up lending to them. What is it going to do for the people who already could afford loans? They could afford that much more money that they could borrow. You see that? So if you lower the lending criteria where somebody's criteria is down here, this is all they could afford to pay. So you lower the borrowing criteria down so that they could afford to borrow that money now. Well, what about the people who are up here that could already afford to borrow? Well, they could afford to borrow that much more now because you lowered the lending criteria. And so if people can borrow more money, what are homeowners going to want for their homes?
More money.
More money. Only makes sense, right? So this is why you saw the prices skyrocketing. It was enabled by politicians. See, politicians just didn't do nothing. Our economy would run better. Our lives would be simpler. Politicians try to get in there and get their 2 minutes of fame, and they end up screwing things up with their well-meaning intentions. Okay, so I'm not going to even say that he was, I'm not going to even make any political statements or claim that he was just trying to be malicious or try to do something that was just for his political career. Let's just pretend that it was, that he's got a good heart and it was well-meaning, well-intentioned. Okay, well, the road to hell is paved with the best of intentions, right? So a lot of times politicians just did their job and addressed issues instead of looking for issues where they don't exist, then we wouldn't have the problems. A lot of times they make problems worse. And that's a perfect example. That is what opened the floodgates to the predatory lending and giving loans to people that probably should have never gotten to begin with. Not everybody needs to have a home ownership. Some people can't afford it. Everybody deserves to have a home to live in, but you don't necessarily need to own it. You could also rent. All right. If you can't afford it, you may be extending yourself too much. And so this is what opened up the gates to predatory lending. If you watch that movie, The Big Short, they start talking about this, but they touch on that part a little bit, a really small bit. And then they just like pick up on that movie from after that point. All right. But it gives you a little insight on how things worked, how the lending worked. And then banks started lowering their requirements. You didn't even need to prove how much money you made. You could just state it. It's called stated income, stated assets. You tell the bank how much money you made, how much money you got, without having to show them bank statements or pay stubs or tax returns. Stated income, stated assets. If it means whether you can get a loan or not, you think borrowers would lie and say that they made more money and that they had more money in savings if they knew that it wasn't going to be checked up on?
Absolutely.
And thus it happened. Okay. That, you know it. You're in real estate in a different state, right? You know it.
Yep. Yep.
Okay. So I mean, nothing I'm saying here is wrong or incorrect. You know, I'm just trying to show you the bigger picture, because a lot of times people don't realize the picture and what happened behind the scenes that led to this. Okay, now in that last paragraph on the bottom of the page, it says the amount to be financed for the closing costs is added into the base of the loan amount. Therefore, the total amount borrowed, including the upfront mortgage insurance premiums, sometimes may exceed the purchase price if the borrower is going to be financing those closing costs. Because the FHA, did I have you guys highlight that? The FHA borrowers are allowed to finance a portion of their closing costs? I guess I didn't highlight that. It says FHA borrowers are allowed to finance a portion of their closing costs. The amount of the financed closing costs is added into the loan amount. Therefore, the total amount borrowed, including their upfront mortgage insurance premium, which doesn't need to be paid upfront, it could be financed in the mortgage itself, may exceed the purchase price of the property. So basically, they're not only giving you 100% financing, they're giving you like 103% financing. They're lending you more money than the house is worth, which is strange. Highlight the FHA sets stop limits on its loans depending on the price level in different areas of the county. And I just showed you on the FHA website the maximum that they would lend for 1, 2, 3, and 4 family homes in a different county. That's what they're talking about. Okay. So it's set by county, not by municipality. Their maximum lending limits. That's what that statement is saying. On the next page, 245, FHA loans have repair requirements. Basically, they will not loan out money to borrowers for homes that need work. The house has to be in livable condition. Okay, so FHA does have what we refer to as minimum repair requirements. You know, the FHA will not give a loan to a borrower if the paint is peeling on the house, on the exterior or the interior of the house. If the house does not have a stove, a working stove in the kitchen, you're not getting an FHA loan. If there is a dishwasher in the kitchen, you know that the FHA, there's new requirements now that the appraiser, not a home inspector, but an appraiser has to turn on the dishwasher and run it through its cycles to make sure it doesn't leak. They're looking for certain issues, certain problems, to make sure that that borrower is not buying a home that needs certain repairs. If the front steps are cracked, if the railings are loose, the FHA will not lend money to that borrower. Why are they being so picky like that? Anybody? Can you guess? Why does the FHA care about that? Well, why do most people get FHA loans? Because they don't have a lot of money to put down when buying a house. And if they don't got enough money to put down when buying a house, they figure that they don't have money to do the repairs. So they don't want people buying a house that they can't really live in and afford to fix up. So they figure the FHA is looking out for that buyer. This is why FHA does has these certain minimum repair requirements. Now, FHA also has an occupancy requirement because it's for owner-occupied people, owner-occupied homes only. It's not meant to be for investors. So under occupancy requirement, highlight borrowers must intend to occupy the property. You have to understand this for exams. FHA loans are only for owner-occupied homes. They're not for investors. You're only allowed to have one outstanding FHA loan at a time because you could only live in one home at a time. Does that make sense?
Yes.
Okay. Now, FHA loans, it is possible that they may be assumed. Older FHA loans can be assumed. Newer ones can be assumed, but only if the buyer qualifies for the loan. All right, so under assumability, just highlight FHA loan, and then later on in that line, highlight may be assumed. Don't worry about the dates there. The older loans before December 15th, 1989 can be taken over. They could just be assumed by somebody else. However, newer FHA loans after that date, they can be assumed as well, but the borrower needs to get qualified for the loan as well. All right, go down to other FHA programs. FHA has a lot of different other types of loans that are out there. They have adjustable rate mortgages. They got special plans for veterans, teachers, law enforcement officers, for rehab of housing, and for no down payment purchases as well. FHA also has financing available for mobile homes and manufactured homes, you know, factory-made homes that are then just shipped out and assembled in a day or two, put together like Legos. Condominiums and rehab construction. Highlights the FHA Section 203K mortgages allow one loan to cover both the purchase price and extensive rehabilitation work. I'm going to show you something about that in a minute. Section 203K mortgages may also be used to refinancing to cover the existing loan plus remodeling jobs. All right, so basically, if you already own a home and you don't have an FHA loan, or if you already own a home and you have an FHA loan, you could refinance into an FHA 203K loan that'll pay off your existing loan and to a new FHA loan. One loan that will pay off your existing mortgage and another loan to do extensive rehabilitation work, like adding a garage or remodeling the house. But wait a minute. What is extensive considered to be? Are there any limits on that extensive rehabilitation work?
I'm sure there are.
All right, well, let's take a look at this.
Don't you think?
Because you guys came and picked up the books at my house, right? Or did I hand them out to you at the office? There's a home right around the corner from my house. Maybe like 10 houses away from me, around the corner from my house. That I'm going to show you some pictures of right now. They're using an FHA 203K loan. Trying to find the pictures of it. Now, it's for extensive rehabilitation work, right? Oh, here we go. Right? It's for extensive rehab work on a home. I'm opening up the photos right now, and then I'm going to show them to you. Once it opens up. Well, what is extensive rehab work? This is what they did.
Isn't that when you like take it down to the stud and just actually have like one
Look at
wall
this, look at this
standing?
photo. Look at this photo. They tore down the entire house. They only have one wall
Yeah.
with the chimney there, which eventually they tore that down once they were able to put up a post for the main electric to the house. They only left the original garage standing. They dug out the foundation to double the footprint size of the house into the backyard. And they built an entire new house around the garage. This is an old builder's trick.
Yeah, they do it to save time on the zoning, right?
That's not the reason why they do it. The reason why they do this, I'm trying to show this to you at a couple different angles here. The reason why they do this, it's an old builder's trick. If you leave up one original wall standing, you know, they tore this one down too. They ended up just keeping the garage and built a new house around the garage. If you leave one original wall standing and you build a whole new house around it, is it a new house?
No.
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 The home is based on whatever the original walls build date was. So if this house was built in the 50s, on tax records, it's still going to show that that home is built in the 50s. It's 1950 something. Remodeled in 2020. This is the new home that they're building there. I got to take another picture because they're practically done with it now.
So you're saying it's a tax credit kind of thing?
City Hall is stupid.
Well,
Nobody ever accused your local politician of being bright. You see, this home used to be this home. They tore everything down except for the garage. They doubled the footprint of the basement. See, the basement used to only be half this size. They doubled it into the backyard. They actually dug out in the backyard, doubled the basement, built up the walls, doubled the depth of the house, and also put up an entire second floor on the house as well, even above the garage. You see this?
And they did all of this with the 203K?
With a 203K.
Wow. We didn't take the 203K.
It's extensive rehabilitation work. What, you know, a lot of people think extensive rehab is I remodel my kitchen.
Right.
Or I build a garage because it doesn't have one.
If I would have known this, I would have took the 203K.
You still can. You still
Really?
can. That's what we just read. That's why I was showing this to you. It says that Section 203K mortgages may also be used to refinance to cover the existing mortgage on a house, plus do extensive rehab. So you could refinance right now your loan on your house into a 203K.
Oh, wow.
They'll pay off your existing mortgage and give you additional money to do this. However, they're not just going to give you a check and hope that you do this. They're going to pay the contractor directly. So you have to submit to the FHA the plans for the construction. So they want to see the blueprints, what you're planning for the work that you're planning to do. Then they want to see they want the contractor's information. The contractor has to be able to do the work up front and provide the materials up front. And as the work is done in stages, they'll send out an appraiser, like stage one or phase one of the construction is done. They'll send out an appraiser to go out to ensure that the entire phase one of construction work is done according to the plans of the agreement. And if it is, they'll give the okay to the bank. The bank releases the funds to the contractor, reimbursing them for paying them for construction of phase one for the materials and the labor that they provided up front. And then stage 2 of the construction will begin. And it goes on like that. So they don't give the money to the homeowner and hope that they pay a contractor to do the work. They pay the contractor directly. See, these are a little bit older photos. Since then, they did some adjustments. You see, this is where the front door of the house used to be. You see the steps are still there. The front door is over here now. Yeah, because this is all new home. It's an entirely new home. I got to take pictures of this house again. Maybe during lunch, I'm going to run out and snap a photo of it, and I'll upload it and show it to you guys after lunch later. Okay.
Yeah, it looks like it's going to be nice.
Yeah. So yeah, it's big. It's big. That's for sure. You know, it's more than double the size of this house because they went deeper and higher. See, it'd be double if they just did the entire second level, but they did the entire second level and above the garage. So that's more than double the size. And then plus it's out here. So this is 1, 2, 3 1/4. It's 3 1/4 times the size of this house.
Wow. I know the people around them are happy because they're going to make their property value go up.
Yeah, when this happens all over the place, and look, it does. There's another block next to me in the other direction, also 1 block away from me, where there's about 5 homes that did this. Wow. Now, what do I mean by the city hall is stupid? Well, you know what? Because you go down to City Hall, the permit department and the taxing department, they're usually next door to each other or across the hall from each other down at City Hall, right? The tax man and the building permits department. You know, they don't even communicate with each other.
Do they ever?
Well, the thing is, you would figure that, hey, if you do construction on your house, your taxes are going up, right?
Yeah.
Because the 2 departments are communicating. If you get permits, they just got to tell the tax department, hey, they did all these improvements to the house. Nope, never talk to each other. I could probably count on one hand how many municipalities in New Jersey, actually the building department and the tax department talk to each other. Majority of the municipalities in the state of New Jersey do not communicate with each other. So as far as they're concerned, what year is this house going to show on tax records? Well, if it was built in 1955, it's showing as a 1955 home. Because it has a bit of the original foundation and a bit of the original wall from a 1955 home that was remodeled in 2020. Ain't that something? It's an old builder's trick. All right. So that's what I just wanted to show you guys. Get your heads wrapped around that a little bit. All right. So their taxes ain't going to go up as much as you think they're going to, even though that house is more than triple the size of what it used to be. Highlight the FHA in the next paragraph. The FHA, for either an FHA or VA mortgage, which we already know about this one. What is the purpose of the special amendatory clause required for all FHA and VA loans? It states that if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty. So we're highlighting this paragraph that says that.
So you don't need an appraisal contingency then? You just, that's
No,
automatic?
no, hold on. If you get what, for the 203K?
Yeah, well.
No, for the 203K, they're giving you 1 loan for the value of the home and another loan to do repairs on the home. Now, how much will they lend you? Well, they'll lend you an amount of money based on the after repair value, they call it.
Mm-hmm.
So they have to try to estimate after all those repairs that you're telling them that you want to do or improvements you want to do, they're guesstimating what the home is going to be worth after that. Mm-hmm. And they're basing how much they're going to lend you on that.
Right. And it says here, the buyer is not obligated to complete the purchase.
All right, well, no. This is for the special amendatory clause. Okay, so anytime somebody's getting a loan from the FHA or the VA to purchase a home, this clause must be added to the purchase contract that stipulates that when they get the appraisal for the home they're purchasing, if the house does not appraise for the purchase price, in other words, you made an offer on a house and now an appraiser comes in and says, wait a minute, the house ain't worth it.
You don't have to buy it.
You don't have to buy it. The house, that's what that clause basically states. So the buyer will not be considered in breach of contract if they back out of the purchase because the house did not appraise for the purchase price.
Okay, but do they need like a separate appraisal contingency, or that's just like an
That's
automatic
That's
built in?
right there.
That is it. Okay.
All
Okay.
right.
Huh. Yeah.
You need to know this. This is usually an exam question on exam. What is the purpose of the special amendatory clause that must be added to all purchase contracts when the financing is made through the FHA or VA? It stipulates that if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty. As a matter of fact, let's write that at the end of this. So you highlighted this whole paragraph that said for either FHA or VA mortgage loan, an extra mandatory clause must be included in the sale contract that states if the property appraises for less than the agreed upon sale price, the buyer is not obligated to complete the purchase. In other words, they can get out of the contract without penalty. So write that at the end of the line. They can get out of the contract without penalty. Because I think that's the wording that they use on exams. Hint, hint. They can get out of the contract without penalty. And I got that somewhere in here too. Look, oh, here, look at this, this bullet point right here. Requires an upfront mortgage insurance premium called oh, wait, no, that's not it. Where's special mandatory clause? On the next line. Range, your loan amount for an occupied one home. I don't know. It's going to be on one of the slides here, but you know, let me try to make this slide just a little more complete and add that in here. If I could squeeze it in. That mandatory clause must be added to purchase contract that says if property does not appraise for the purchase price, buyer can get out of the contract without penalty. Not be in breach of contract. How about that? Let me try to make this bigger. Yeah. Make that title a little smaller. I'll try to squeeze it all in one slide here for you guys. It's a little bit difficult. You can only fit so much on these slides, you know? Yeah. Well, the links are a little bit lower here. Damn. Let's see if there's anything I can combine here. FHA does not lend money. Here, I'm going to combine these two in one line. FHA insures loans. How about that? I'm going to change this a little bit to FHA insures loans Insuring lender for entire loan amount against loss. Doesn't lend money. Okay. Fits a little bit better. Let me see if we can combine anything else here. Maximum seller concession up to 6% of loan permitted. Requires upfront mortgage insurance premium MIP charged at closing that can be wrapped into the loan itself. May be able to finance some of the closing costs. All right, good enough. Made it fit enough. Got only one bullet point that's hanging off here a little bit. All right, so we got a pretty complete, this is a pretty complete slide to study from. Here, let me try. I think I can squeeze it up a little bit. Can we? There we go. A little bit. We got it in. We got it in. So this is a great slide to study from. It's got just about everything you need to know about the FHA loan, right?
Awesome.
All right. Now we're going to talk about VA loans. Okay. Now, by the way, a lot of stuff here about FHA loans. You get a couple questions on FHA loans on exams, without a doubt. Without a doubt. Definitely study this slide. Okay. All right. VA loans. VA is the Veterans Administration, or that's not officially what's called, Veterans Administration or Veterans Department of Veteran Affairs. There we go. And VA guarantees lending institutions. They guarantee loans. They don't insure loans. They guarantee 25% of the loan. So the second line we're going to highlight, the VA guarantees the top 25% of the loan. No down payment is required. Because they guarantee 25% of the loan, it's as if the borrower put down 25%. Even though the VA is not paying 25%, only in the event that the borrower defaults, okay? But because of that guarantee from the government, banks are like, that money's as good as in the bank. So if you put down how much money are you not required to carry PMI?
20%.
20%. They're guaranteeing 25%. So that's why they don't require any down payment. No money down. And they still don't got to be PMI. So they do have lending limits, just like the FHA does. You know, the FHA got those lending limits for 1 to 4 family homes, depending on the county that they live in. It could vary. Well, the VA does too. Their lending limits for a 1-family home are $424,350 in the lower cost counties to $726,525 in the more expensive counties in New Jersey. Okay. Appraisal for your VA loan is called the CRV. Before we get into that, at the bottom of this page, let's highlight only for owner occupied property owned or co-owned by a veteran. You have to be a veteran in order to get a VA loan. At least one of the borrowers has to be a veteran in order to get a VA loan. Then turn the page. As with the FHA loans, the VA loans have to have that amendatory clause that states if the borrower, if the house is not appraised for the purchase price, the borrower can get out of the contract without penalty. Does that say it in here somewhere? Intended for owner occupied 1 to 4 family dwellings. VA guarantees 25% of the loan, has lending limits. Appraisal for the VA is called the CRV, discount points, funding. Let me put that statement, let me copy that, that's from the previous slide, the amendatory clause. Statement. I'll copy it over into this slide. We're gonna add that in here. 1 to 4 family dwellings. All right. So it says, see, I added it in here. The amendatory clause must be added to the purchase contract that states, so we have to add this to the purchase contract that states if the property does not appraise for the purchase price, the buyer can get out of the contract without penalty and not be considered to be in breach of contract. All right. Now, let's highlight in the book the next one. CRV, Certificate of Reasonable Value. A VA appraisal is called a CRV, Certificate of Reasonable Value. That's usually on state exam. What do you call the appraisal statement for a VA loan? CRV, Certificate of Reasonable Value. Study that. It will be on exam. The way I get people sometimes to remember it is something kind of nonsensical, has nothing to do with appraisals, but people tend to remember it this way. Just think of Honda CRV, the car. You guys know the vehicle, the Honda CRV? I don't know. For some reason, when I say that to people, what do you call the VA appraisal statement? And I just say, remember Honda CRV. For some reason, they remember it. I can't explain it, but it works. Okay. So Honda CRV, Certificate of Reasonable Value, CRV. Okay, they're able to remember it that way. Okay. Now, discount points may be paid by the seller, the buyer, or shared by them. What are basically discount points? They're points on your loan. What are points? Prepaid interest on the loan. Who could deduct them on their taxes? Who could deduct the interest that's paid on their loan on their taxes?
The buyer?
Buyer. It's their loan, right? Even if the seller pays them, it's the buyer's loan, they get the statement, the tax statement at the end of the year. All right. There is a funding or an application fee. They call it a funding fee. It's basically an application. There's a funding fee that has to be paid by the borrower. Or the borrower can negotiate and have the seller pay that funding fee as well. So the borrower, even though it's 100% financing for the veteran, they do have to pay a funding fee. Now that funding fee is going to be higher. Well, the funding fee can be lower or canceled for disabled veterans. Certain veterans like veterans from the National Guard or reserves pay higher funding fees. Now, the seller can pay the funding fee for the veteran as well. Now, there's certain eligibility requirements, which I put here. They had to serve 90 consecutive days during active duty wartime in order to qualify for the veterans benefits, or 181 days of active service during peacetime, or 6 years in the reserves or National Guard. But if you were in the reserves or National Guard and you were serving overseas during wartime, it's only 90 days, right? And loans can be assumed, not required to be a veteran. All right, so do you have to be a veteran in order to assume a VA loan? No. I'm gonna adjust that slide there right now. I'm just gonna say that not required to be a veteran to assume. Oh, I already have it there, to assume the loan. All right, that's tricky and sometimes a question on exam. Are VA loans assumable? Yes. Do you have to be a veteran to get a VA loan?
No, but
hold on. Yes.
Yes.
Yes. You must be.
You just said no.
No.
Yeah.
No. Listen to what I said. This is why I asked the question. Do you need to be a veteran to get a VA loan? Yes. It's intended for veteran-owned or co-owned or for 1 to 4 family dwellings. But for refinance, I'm sorry, for assuming a loan, do you have to be a veteran? No.
Well, I was going to ask you, can you explain what assume
Yes.
like
Assume means that you're taking over the payments for someone else. You're taking
Okay.
over a loan that's existing. Most loans have a clause in them that state when you transfer the ownership, the loan has to be paid off in full. What's that clause called? You know it from chapter 13, I believe it was in.
Prepayment penalty?
No prepayment penalties allowed in New Jersey. What do we call the clause that's in the mortgage that states that if you transfer the ownership, whether you're selling it or giving it away, the loan has to be paid off. It's not assumable. That's the purpose of this clause. What is that clause called?
Is it the alienation clause?
Alienation clause, which is also known as the due on sale clause in the note. It's due on sale, or when you transfer the ownership. What does alienation mean? Transfer of ownership. So the alienation clause states that when you transfer the ownership, whether you sell it or give it away, the loan needs to be paid off in full. It's not assumable. The purpose of that clause is to prevent loans from being assumed, especially if they're at a lower interest rate. They want people to get new loans. Okay. However, FHA loans and VA loans can be assumed. However, they do have alienation clauses in them. However, it's up to the lender's discretion whether they allow it to be assumed or not. So they're kind of like modified alienation clauses, right? All right. But I just want you to get you thinking about that because the alienation clause you need to get on exam. So what is it also known as, an alienation clause?
Due on sale.
Due on sale.
And what is its purpose?
To pay off loan.
Why?
To assume ownership.
To make sure that it's not assumable. The purpose of the alienation due on sale clause is to ensure that when you transfer ownership, the loan has to be paid off in full so that the loan cannot be assumed. That's the purpose of the due on sale or alienation clause. All right. So I have some links over here. So for additional information about VA loans and VA benefits for veterans, okay? You guys can add this stuff to your websites. There's content there. I also have some of these links in the class links Word document. All right. So New Jersey homebuyer programs. Let's see. Oh, let's go to assumability down the bottom of the page, 246. Let's highlight the any VA mortgage loan. Stop highlighting there. Skip the dates because it says made before March 1st, 1988. And then resume highlighting. May be assumed by the next owner of the property who need not be a veteran. So even though you need to be a veteran in order to get a VA loan, you do not need to be a veteran to assume one of those loans. That's what that question was that I was asking you about. That's the point I was trying to make. You have to be a veteran to qualify for a VA loan. You do not need to be a veteran to take over a VA loan. Okay. And what do we call the appraisal statement for a VA loan?
CRV.
All right, thank you very much. All right, now we have the New Jersey Homebuyers Program that comes from the NJHMFA. That's abbreviation for the New Jersey Housing and Mortgage Finance Agency. They offer below market interest loans with little or no down payment to qualified buyers in urban target areas. Okay, the qualified buyer, what is that? That means an owner occupant, not investors. In urban target areas. What's an urban area?
Highly populated. Like
Densely
city.
populated area. So the NJHMFA does not lend money though. Once again, they only have certain qualified lenders. You can only go to certain lenders to get the NJHMFA loan. And they have all kinds of loan programs for police and firemen, teachers, people who go to work in off-peak hours to try to incentivize relieving congestion on our busy roads. They have a first-time homebuyers program called the New Jersey Smart Start program. That one's interesting. They'll give 2 loans to a buyer. One loan to purchase the house, another loan for the down payment and or closing costs. That second loan is at a higher interest rate. But if you live in that house for at least 5 years, you don't have to pay it back. In order to qualify for this loan, though, they require that the borrower take a class. It's kind of like a home economics class. They teach you how to balance a checkbook and how to do simple basic repairs in the house. You know, because they don't want somebody to, first-time home buyer, to be buying a house and now they got to go hiring plumbers and everything when they got a dripping faucet. They'll show you how to replace a washer, you know. They'll teach you how to replace the air filter in your HVAC system, you know. They teach you basic home maintenance in this class. And then you could get this loan for below market interest rates with little or no down payment. Now, let me show you some more details. I got another slide that has a little more details about that program. This is the slide that shows you about it. The NJ Smart Start program, they give you 1 loan to buy the house, 2nd loan to finance the cost of the purchase price or down payment. They refer to that 2nd loan as a self-liquidating loan. That 2nd loan is a higher interest rate. However, if you live in the house for at least 5 years, you pay back none of it. If you live in it for 4 years and then you sell the home, you got to pay back 25% of that higher interest rate loan. If you sell it after only 3 years, you pay back 50%, 2 years, 75%, a year or less, you're paying 100% of it back. Makes sense? One loan, okay, see, first-time home buyer's loan to buy the house and for down payment and closing costs. Buyers, okay, the 2nd loan is at a higher interest rate, okay. And then over here, I'm gonna just say, see next slide for details. All right. Now we also have the, so if you want some resources, some more information about those NJHMFA program, here's some website links I got here on this slide for it. There's 1, there's 2. And here, there's a 3rd link there. We have you could go to njhousing.gov, which is a little more consumer friendly the way the layout is. And then you have these other 2 website links to their website there as well. All right. So these are the links for the NJHMFA, or you can call 1-800-NJ-HOUSE. So I'm giving you guys some resources. Sometimes you may have first-time home buyers and they say, are there any special programs available out there for borrowers, for first-time home buyers? Sure, sometimes municipalities have special programs, or you could just go to NJHMFA and get them too. They got their own loans, okay? And then we have the Rec D. Did you highlight anything under NJHMFA or no? Did I tell you to highlight anything? If not, highlight the first sentence. The NJHMFA offers below market rate interest loans with little or no down payment to qualified buyers who purchase homes in urban target areas. What areas?
Urban
target.
All right. That may be a question on exam, hint, hint. All right. And then we have the Rec D. This is formerly called the Rural Economic Community Development, or the Farmer Home Loan Association. They give loans to farmers and to people who live in rural areas. Even today, it is possible to get 100% financing through them. So low income and first time home buyers, subsidized interest rates as low as 1% interest rates. For modest homes, loans come directly from the Department of Agriculture, and loans are available with as much as 100% financing. So I'm going to add that too. 100% financing available. Boom. You know what that means?
Zero down.
No down payment requirement. So what's the LTV? So what's the LTV on that loan?
100%.
There you go. Not a trick question. Just want to see if you know what you're talking about.
Just a question. What's the definition of modest homes for them?
Not expensive.
But do they have a defined amount or?
You got to check their guidelines. You got to go to their website and check their guidelines. They may vary per county or per area. I'm not sure how they work it, but yes, they do have some sort of a guideline. Don't know what it is. But I gave you some links here, which you could go to their website to find out. They're not making it as easy to get that information anymore, though. You have to go through their website and actually fill out like an address that you may be interested in. Previously, you could just go and search their website and they'll pull up a map and you could see this browse the state area. You could pull up a map and you could see what a rural, what they classify as a rural area. You could pull it up on what's kind of like a Google map, and in the areas that are shaded pink, I think are considered rural, where you could get their loans. But I think you have to actually put in an address now in order to browse that map. You have to, not even just the street, you have to put an actual address in, and then you could scan that area around there. Let me see. What is a rural area? You see their maps over here. A lot of New Jersey is, believe it or not. A lot of New Jersey metro. But we do have rural areas here. They have an interactive map somewhere which you can take a look. Let me check another link here. Browse the state. Let me look from the USDA's website. You can look at New Jersey. Yeah. I'm not sure where that map is. You got to look in their, they don't make it easy to find anymore. Let me see this last link. Thought I had a link here that you can take a look at it. Okay, determine your income and property eligibility. You got to surf around this website a little bit. I haven't done it since they redid the website, and tried to search the map for the rural areas. They used to have it easy to search out. Now they hide it somewhere in the website, so you got to search around a little bit to find it. But I got 3 links here at the bottom of this slideshow that you could use to go to the USDA's website and look for that rural population density map in New Jersey. Let me see if I can just do a Google search for that too. USDA rural area map. Oh, New Jersey. Oh, well, how about we just look at rural area map 2020. Oh, hold on a second. I didn't see it because I got your videos up in front of me. Okay, so if you're on their website, I do have the link up there. Remember, I took you right here to this, right? if you click on accept, whatever that disclaimer, oh, here we go. And then the map comes up. All right. And then you just got to type the address in here, or I don't know if you could put in an area. I think you got to put an address, an actual address in there. And then you could check the areas if they're considered rural or not. Let's see, what about New Brunswick? You know, I don't know if I could just type in a town here. New Brunswick, New Jersey. Yeah, you got to put in an actual address. It makes it a little bit harder, but you got to put an actual address, and then you can browse it and pull the map around and look around the different areas, whether it's it considered to be in a rural area or not. All right, so that tool is available. I do have the links on that slideshow for it. Okay. Here we go. What's going on here? Oh. You guys seeing the slideshow? Keeps pulling me back to the browser. Okay. All right, that's the end of that chapter. All right, so let's do the key terms to review. Low down payment insured mortgage loan.
FHA.
FHA.
14 is A, the FHA 203B to be more specific. Yes. Insured loans with monthly payments, including the property taxes and insurance.
Budget loans.
8 is B, the budget loan. A mortgage that can be taken over by the next buyer.
Assumable loan.
Assumable loan, 5 is C. A VA appraisal statement,
A CRV, 12.
12 is D, correct. Highest interest rate ever allowed on a specific adjustable loan, what do we call that?
The ceiling.
Ceiling, 11
Cap.
is E. Nope, it's a
A
ceiling.
ceiling.
Listing of
Got
each
it.
payment, interest, principal paid, and remaining debt.
Amortization
schedule.
Amortization schedule, 3 is F. Payment of extra points in return for a lower interest rate.
Wait, what was that one? My computer froze, sorry.
Amortization schedule, 3 is F.
Thank you.
You're welcome. Payment of extra points in return for lower interest rate.
buy down.
Call it a buy down, 9 is G. States that the buyer getting an FHA loan can rescind the contract if the appraisal comes in lower than the purchase price.
A mandatory clause.
2 is H, correct. Percentage beyond which interest rate cannot be raised at adjustment.
That's a cap.
That's the cap, 10 is I.
Okay.
A plan with interest rate changed either up or down periodically.
Adjustable mortgage rate.
Adjustable.
Yep, the ARM.
Adjustable rate mortgage.
1 is J. A repayment plan including principal payments gradually reducing the debt.
Amortized loan.
Amortized loan, 4 is K. A repayment plan, the equivalent of 13 monthly payments per year.
Bi-weekly.
Bi-weekly mortgage.
6 is, was that L or?
Oh.
Yeah, 6 is L. U.S. agency that insures mortgage to protect lending institutions.
Federal
FHA.
housing.
FHA.
13 is M. And written estimate of value by a real estate licensee.
BPO.
BPO.
PPO, correct. Okay, oh, there's another key terms to review on the next page.
I'm sorry.
Yeah.
I got, okay, so FHA, because there's 2 FHA, the 203. I got it right, but.
No, there's one loan that's a FHA 203B, 14 is
Right.
A.
Okay.
And you have the Federal Housing Administration, 13 is M.
Okay.
Okay, so one is the FHA specific loan, the 203B. The other one is FHA, the agency FHA.
Okay.
Okay. You need any? Very good.
No, I'm good. Thank you so
All right.
much.
You're welcome. Key terms to review. Number 2, a charge for the use of other people's money. What do we refer to that as?
Interest.
Interest.
2 is A. A guide to national mortgage trends used for adjustable rate mortgages.
Index.
One is B. A lender of low interest money in certain areas.
New Jersey Housing and 8 Mortgage Finance Agency.
Yep. 5 is C. Mortgage payment, including interest, amortization, and certain expenses.
Pity.
Pity.
6 is D. A mortgage with payments of interest only.
Straight.
Straight loan.
9 is E. A loan guaranteed by the federal government. Who guarantees loans?
The VA.
11 is F, the VA. Neighborhoods in which the state wishes to strengthen housing stock.
Target area.
10 is G. 1% of the loan amount charged as an extra upfront interest when the loan is made.
Point.
A point. 7 is H. Percentage charged by the lender above the index rate.
Margin.
4 is I. Percentage of property's market value that may be borrowed.
Is that
Loan to value.
3 is J, loan to value ratio. Protection for lender on low down payment mortgage loan.
PMI.
Right.
8 is K, private mortgage insurance or PMI. Lender agrees to hold the interest rate for a certain period of time.
Rate lock.
Rate lock.
14 is L, rate lock. Difference between the current value and money owed.
Equity.
Equity.
12 is M. An explanation of financing terms.
Your home loan toolkit.
A toolkit, yes. 13 is N. All right, so this is the last chapter on financing, chapter 15. But we kind of did some stuff in it already as we were traversing through chapter 14. We were jumping back between, and chapter 13, we kind of jumped back and forth between 15 a little bit here and there. So we may see some things are already highlighted here in chapter 15. Let me get the slideshow open.
I don't know if you guys can hear me, but Victor, my bird is repeating what you're saying.
Is he?
Yeah.
Well, you got a study buddy.
That's really funny.
Get yourself a little study buddy there. Look at that.
That's
He can help you
hysterical.
during the exam.
Right.
That's
Funny.
He gonna get me disqualified.
I was just about to say that.
What's he saying? Anything good?
No, he just repeating some of your words. Now he's saying hello and hi.
Hello, Tweety Bird.
That's so funny.
What's a purchase money mortgage? What's a purchase money mortgage? What is a purchase money mortgage? Read it backwards. Mortgage money to purchase.
Mortgage money.
Mortgage money to purchase. Mortgage money to purchase. Anyway,
Mhm.
so let's highlight that in the book.
Mhm.
Purchase money mortgage is any mortgage. It's a classification of all mortgages that are used to buy real estate. It's not the first time we heard that. It's just the first time we're highlighting it. Maybe. No, I think we did highlight it somewhere else before. Now, go to the next paragraph, and we're going to highlight a reverse mortgage is one which regular monthly payments are made to the borrower. It's reverse of what the normal is. Usually the borrower is making payments to the bank, right? This is the lender making monthly mortgage payments to the borrower. I want you to write above that or below it, loans to seniors who have at least 60 to 70% equity. And then write somewhere there, if you have room, maybe below it, first loan, not a second. A reverse mortgage is a first loan. It'll be the only loan on the house. So it's not considered a second loan. It's a first loan, not a second. All right. So reverse mortgage is when senior citizens, well, let's first go over this chapters here. Chapter 15, we're going to talk about different types of loans and various financing techniques. We're going to talk about the primary mortgage market and the secondary mortgage market, which I already explained to you guys a bit of. Primary mortgage market is when loans are originated to purchase real estate. Secondary mortgage market is when those loans are resold to investors. Remember, we spoke about that a bit. So I basically have a first slide here that shows how lending works in a nutshell. You know, it talks about the primary mortgage market, what the secondary market is, like I just explained. And the primary mortgage market lenders, where you get money from to buy real estate, are mortgage bankers, mortgage brokers, and credit unions. And some of the big players in the secondary mortgage market who purchase, these investors that purchase loans from banks, are Fannie Mae, Ginnie Mae, and Freddie Mac. Okay. Fannie Mae is the largest purchaser of loans in the secondary market. They buy about 1 out of every 10 loans that are out there. So because they're such a big player, when your local bank originates a loan, they originate that loan using lending guidelines of the most probable purchasers, the investors in the secondary market. So because Fannie Mae is such a big player, when they change their lending criteria of the loans that they're willing to purchase, what do you think the local lender does? They match their criteria to Fannie Mae's. When Fannie Mae talks, lenders listen. All right. And then Ginnie Mae is Fannie's ugly stepsister. What do I mean by that? Well, she buys ugly loans. All right. The risky loans. Ones where people aren't putting down a lot of money, or loans that may not be performing as much, or loans to people with less than perfect credit, shall we say. They're purchased by Ginnie. Okay. Why do I say it like that? It's Fannie Mae's ugly stepsister. Because sometimes on exam, people get a question it's a little bit weird. It asks it'll give you a list of different loans and it'll say which one of these lenders are related. So I'm telling it to you in a story way. Fannie Mae is the largest purchaser of loans out there, and Ginnie is Fannie's ugly stepsister. So now you know they're related. Okay. You know, I'm just trying to help you out. It's weird the way that they ask these questions sometimes, and I don't know why they do. I don't even know what it has to do with your licensing, but or us for that matter. But you know, so. But I know you get it, so I throw it in there. All right, and then Fannie Mac, Freddie Mac. Jesus Christ. I need my coffee. My coffee got cold on me, and I didn't drink it all. My go-go juice. So Freddie Mac purchases loans from portfolio lenders. Yes, I know portfolio lenders write loans without the intent of reselling them. But sometimes they need to get capital so that they could write new loans. So what they'll do is they may sell off some of their investments, but who's going to buy them? They wrote those loans without the intent of reselling them. Well, Freddie Mac will. But they'll analyze each loan on a case-by-case basis to see if they'll purchase it. All right. So Purchase money mortgage is, read it backwards, it's any mortgage used to purchase real estate. Reverse mortgages allow senior citizens 62 or older to tap into equity that they already have built into their homes. Over their lifetime, they've been paying their mortgages. If they didn't pay them off yet, they should have them pretty close to it being paid off, right? So hopefully they have a lot of equity built up in their homes already. It allows a senior who does not have a large retirement savings plan, or they're not on any government pensions, or have a way to live. If they don't have large savings or a big government pension to get, how are they going to live out their senior years in dignity? You know, are they going to be deciding, do I buy my food, or do I pay for my medication that I need to live on? You know, thank goodness these days we have a lot of programs out there with drug companies that if you can't afford your medication, they have programs that assist people to get their medication at low cost or free. All right. I don't know if you guys recall, but years ago there used to be a talk show host. He was I think he was a Marine. He was in the military. His name was Montel Williams. Anyway, he started doing a lot of these advocacy programs because he saw there was a need, that there was a lot of people in need that couldn't afford these expensive drugs. So he started working with pharmaceutical companies to try to put programs in place to help those people in need, those people who could not afford these expensive medications that they needed to survive, in order to get them at discount rates or for free. And today there's a lot of different programs available out there like that for seniors or poor people to be able to get the drugs that they need to survive. It used to not be like that. It used to be that, you know, you're a senior, you live off of your savings. If you don't have a pension and you only have meager savings, well, Social Security, here's a little shocker for you, don't pay a lot of money, okay? You ain't gonna live off of Social Security alone. So if you're planning on retiring someday and you think that you're gonna live off your Social Security, you're in for a rude awakening, my friends. You're gonna have a hard time getting by. So I remember when I was growing up, we used to see commercials, well, not commercials on TV, but the news. And there was a lot of news stories where I remember them. They made an impact on me as a child watching them on the news, where they were interviewing like seniors, and they're like, well, how are you getting by? How are you living with you know, your Social Security? They're like, well, it doesn't pay much. And if you don't have a lot of savings, you're on a fixed budget. And so sometimes, you know, you have to decide, do I buy the medication that I need in order to live, or do I buy food to eat? I mean, imagine being put in such a position. And in the meantime, the person's over there petting their cat, you know? So, and the person says, so, I mean, I need the medication to live, so I have to get the medication. So they spend their money on the medication. And then they said, well, then how do you live? How do you get by? Well, we have this cat food. If it's sufficient for the cat to have enough minerals and stuff in there for them to eat and live off of, it's got to be able to, you know, be good enough for me. So people are getting by eating cat food.
Oh God.
That's not living out your senior years in dignity. You know, you're eating pet food in order to survive, you know? So that's why they ended up passing a lot of programs, and they put a lot of these different programs in place like this. But back then, that was the early 80s. And I believe it was Ronald Reagan was president back then. And he created this program by talking with lenders and talking with Congress to pass laws that would allow, you know, they're trying to figure out a way, how could you give money to seniors to get by like that? I mean, we already have programs out there called Social Security, you know, but those benefits they're only so much, you know? So he came up with this idea, listen, a lot of these seniors are homeowners. They've been paying for a mortgage their whole lives. they're sitting on their retirement plan. They're living in their retirement plan. If there was a way that they could possibly pull out the equity that they paid into the house, so they created this reverse mortgage program that allows lenders to pay off. If there's like, say that you have 70% of your home paid off, so you got 70% equity in a home. So basically you owe 30%. So you get a loan from a lender that pays off the remaining 30% balance. So now you only have a loan for 30% of the home balance. This lender now will start paying to the senior monthly mortgage payments to the senior so that they can live off of. They're paying their equity back to the senior. And the senior never has to pay that loan back until they die or sell the property. So it's a way that the senior can actually get money to live off of, and they can live out their golden years, you know, in dignity, instead of just trying to survive off of the meager funds from Social Security. So this is an option that's available to seniors. Now, sometimes, you know, I've had people in the class before, and they're like, "Well, wait a minute. What if you're like the kid, and you don't get to inherit the house now because the bank is going to get it? That's messed up." And when people say that, I'm like, "Wait a minute. Why did the senior have to get this loan to begin with? Because they needed money in order to survive, so they didn't have to eat cat food. Where the hell were you when your parent was having to eat cat food and you weren't there to help them and they had to do this? You know, you got your hand out there waiting for your inheritance for a house, but you're not there to help your senior parent when they're forced to eat cat food. So instead they get the reverse mortgage." I was like, where are your priorities, right? I mean, your parents took care of you when you were growing up. They're the ones that are wiping your ass and changing your diapers, right? Feeding you, putting a roof over your head. But these days, this is modern society for us, you know? Kids yell and curse at their parents and they don't take care of them, you know, and you got to be there for them when they get older, you know? It ain't easy, but it wasn't easy for them taking care of you either when you were a toddler, right? Anyway, enough said on that. So the mortgagee makes small monthly payments to the mortgagor, building up debt. This is the way that you could see it on exam. It would use some kind of wording like that. What kind of loan? What kind of loan? What do you call the type of loan where a mortgagee makes small monthly payments to the mortgagor, building up debt? Think about it for a second. Who is the mortgagee and who's the mortgagor?
The mortgagee is the mortgage company.
The lender. And the mortgagor is the borrower. Right? So the lender makes small monthly payments to the borrower, building up debt. That would be a reverse mortgage. All right. So the senior doesn't have to pay the loan back until they sell the home or they die. Okay. Now, if you are the one that was scheduled to inherit that property, you could still inherit the property. You just got to pay back the lender the money that they paid out, plus whatever the interest rate was on it. Otherwise, the lender will sell the house, get their money back, and then the proceeds will go to the heirs. Okay. So when the senior dies, okay, and then that's what goes on. If you want more information about this, there's a website link here, reversemortgage.org. All right. Turn the page. Home equity loan. We're going to highlight a home equity loan as a form of second mortgage. It works kind of the same way as the reverse mortgage. It's a way for somebody who's not a senior to take a loan out against the equity that they have in the home. However, this is considered a second mortgage on a home, and the borrower has to start paying it back right away, just like any loan. But it's a way for a borrower to take out a loan from the built-in value, the equity they have in the home. And once again, what is equity? If you were to define it,
The difference between what's paid and the market value.
hold on, I couldn't hear you at all. You sound very muffled and a mile away.
The difference between what's borrowed on a loan, right, and the market value.
Okay, so it's the difference on the market value of the property and what's owed on it, on the loan. Yes. All right. So you can take a loan out against the equity that you have in your home, that built-in value. Sometimes they also call them HELOCs. That stands for a home equity line of credit. They kind of give you like a credit card based on the value of the equity that you have in the house. And you could only take, and you only have to take out whatever amount it is that you need to borrow. And you use that equity kind of like a line of credit that's available to you whenever you like to use it. That's another way of using the equity that you have in your home. Okay. All right, so bridge loans. What's a bridge loan? Okay, I got a separate slide just for this. When you're buying one home and you're selling one home and you're buying another, we try to, as real estate agents, to make sure that those buyers coincide their closings, to have them at least within a day or two of each other. But that's not always possible. Sometimes the buyer needs to close on the purchase of the new home before they close on the sale of their current one. But if that's the case, people are going to have to make mortgage payments on two homes. And most people, can we agree, can't afford a mortgage on two homes? Have a tough enough time making a mortgage payment on one. So a bridge loan, also referred to sometimes as a swing loan or a form of interim financing, is a temporary loan, usually not meant for periods more than 6 months, that will assist somebody in making the payments on both mortgages for that period of time, so that they could close on the sale of their existing home. So they could bridge the gap between the time that they bought the new home and they sell the old one, so that they can swing the payment in the interim. You see where they get this terminology: bridge loan, swing loan, interim financing? Yeah. All right. So that's what that is. So let's highlight that the third paragraph. We're going to highlight the homeowner who's selling one residence and buying another may find it necessary to purchase the new home before the closing date on the existing one. In this situation, it's temporary loan called a bridge loan, swing loan, or interim financing. And then go to the line beneath it and highlight, such loans are usually provided for interest-only payments and are intended for no more than 6 months. It's a temporary loan. That's why it's interest only. And then when you close on your existing home, you could pay it back in full. Okay. Now, shared equity loan. This is a type of, we're not going to, not really going to have anything here to highlight. But with a shared equity loan, the purchaser needs financial assistance when purchasing. So an investor will lend them money, but they'll also share in the profits when they eventually sell the home. By then, hopefully the property values have gone up. So that investor is counting on, over the years, the value of that home going up. And when you do eventually sell it at a profit, that they're going to share it in the equity. Highlight package mortgage covers not only the real estate, but all fixtures and appliances on the premises. It's a package deal. Sometimes it's used to finance purchases of like new condos that are furnished, or new housing that has fixture. That it's a one loan for both the real estate and the chattel or fixtures. So you could get a loan to buy a new construction that comes with a refrigerator, a washer and dryer, things that are considered personal property and not part of the real estate. It's a package deal. So
but Victor, does that affect the appraisal? I was always like, doesn't that affect the appraisal?
Well, it needs to be noted on an appraiser has to make notation that this value of the property, the purchase price of the property, does also include other items that are not part of the real estate.
Uh-huh.
Because,
like, what if the chattel's worth 20,000?
well, that's why, well, it's up to the lender to lend their money. They can lend it for whatever they want, right?
Uh-huh.
But appraisers, when they're giving you the appraisal of the property, they have to ensure that they put on the appraisal statement
Okay.
that there's other items included. That's just like you as a real estate agent. When we have a listing and we sell a property, we have a buyer. Eventually in the MLS, we have to put down the closing costs.
Mm-hmm.
If there were any seller's concessions made, we have to note, we have to note that in the MLS.
Yeah.
So that when an appraiser or another real estate agent is trying to do a CMA, or an appraiser trying to do an appraisal on a property in the future, sometimes they get that information from MLSs too. And they want to make sure that you're basing the value of the property off of the sale price of just the property. I have sold houses before that threw in a car, a classic car that was in the backyard in the sale. So wait, is a car part of the real estate? No, it's not. It's chattel. It's personal property. So, but if people are doing an appraisal of a house next door that goes up for sale, and then they see, well, what's sold recently in the neighborhood, and they see that this house sold and how much it sold for.
I'm in class right now. Yeah, on Zoom. On Zoom. Hi.
So you have to take into consideration, sorry, I had to mute that. So you had to take into consideration the value of not just the house, but that there was an additional item that was put in there. So that house sales price did not only include the house, there was something extra. Otherwise, that house next door can get appraised by using a comp.
Right. So you're just saying that it just needs to be noted somewhere on the appraisal that the lender is aware that there's additional chattel.
Correct.
Okay, because I'm going to be working in a resort environment, like a beach environment, and a lot of the homes that sell here are fully furnished.
Good for you. Look at you.
So I mean, yeah, it's great, right? So but that's my concern, like, you know what I mean? So now I think I'm clear.
Yeah, if anything's extra, it just needs to be noted, because otherwise you could be raising the values of properties in the neighborhood. And it has nothing to do with the real estate. There's additional chattel that's actually causing the increase of value. It's not that people are willing to pay more for the house. It's people are willing to pay more for the house because other stuff's included in it.
Right. That's what my concern was. So.
Yeah.
Okay, cool.
Yeah, as long as it's notated in there, that's fine. We need to write that in the sales contracts too.
Mm-hmm.
Okay. Then it's up to the lender whether they want to lend the money for that extra stuff or not.
Mm-hmm.
And it also plays in a role when appraisers and real estate agents will value additional properties in the neighborhood. Otherwise, we could be mistakenly driving up the value.
Right, like inflation.
Based on outside factors that shouldn't affect it. So yeah. You're right. Okay, but that's a package mortgage. All right. So let's see. Then we have a blanket mortgage. We're going to highlight a blanket mortgage covers more than one parcel or lot and is used to finance subdivision developments. These mortgages include a provision known as a partial release clause. All right. We know that most mortgages have a clause in them, the alienation or due on sale clause, which says that when you sell a property, you got to pay off the loan. Well, I made this slide over here, this next slide. Here's the slide for the definition of a blanket mortgage. We just highlighted the definition. And here's a picture, a little bit of a drawing I put here. A blanket mortgage would be, let's just say you get this blanket mortgage to buy one large lot that you're then subdividing into 6 smaller lots. A blanket mortgage has a special clause in it called a partial release clause that would allow you to sell off a smaller lot now off of the larger one, and you would only have to pay back a portion of the loan, not the entire loan. Because remember, we have the alienation or due on sale clause that says when you transfer ownership, you got to pay back the loan in full. This is a special type of a loan that that allows you to pay back only part of the loan because you've only sold part of the property. You guys following?
Yeah.
Okay. And I got that explanation written here in the slide as well. Give you guys some visuals here. Hopefully that visual made it easier to understand. A wraparound mortgage, I doubt you're getting this one on exam, but just in case. What do we call the loan? What do we call that clause in the note again that says that when you sell the property, it needs to be paid off in full?
A due on sale clause, the alienation?
The alienation or due on sale clause. Okay, so this marker is going to be my loan. I'm a homeowner. This is my loan on the house. This is my loan that I currently have on the house. Okay. And this, I'm gonna get a blue pen. Maybe you can see it a little better. Okay. And this pen, all right, if my mortgage does not have an alienation clause in it, what's the purpose of the alienation clause again?
To have the loan paid off in full?
Why? What's its purpose? To prevent the loan from being assumed.
Assumed.
So if I don't have an alienation clause in here, does that mean that the loan can be assumed?
Yes.
So does that also mean that I don't have to pay off the loan if I sell the house?
Yes.
You're right. So there's also that possibility then that as long as I keep making my mortgage payments, I could sell this property. I don't have to let somebody else assume it. I could just continue making the payments on it. And then you step in the picture as the buyer, and I could give you seller financing. This pen is the seller financing. The seller financing wraps around the original financing and it never touches it. It never disturbs it. One loan has nothing to do with the other. One loan simply wraps around the other without ever touching it. That's a wraparound mortgage. When
Who would that benefit?
Well, it could benefit the seller. It could benefit the buyer. Let's just say that you as a buyer can't get a loan anywhere for whatever reason. And if the seller's willing to give you financing, you could buy the house. I would say that would benefit you.
Right.
I would say that also brings more buyers to the table for the seller so that the seller is able to sell their house quicker or maybe even at a higher price if they're willing to offer seller financing to a buyer who can't get a loan otherwise. I think it's beneficial to everybody.
So could this be used as a rent to own or like?
Sure.
Okay.
Sure. Normally a seller can't offer financing on their house unless they paid off the loan and they own it free and clear. Because they got that due on sale clause that says that when you transfer the ownership, whether you sell or give it away, it needs to be paid off in full. But if you don't have that alienation clause in the loan, then you're allowed to offer the seller financing, or with certain FHA loans or VA loans. Creative financing, my friends. If you understand how the financing works, then you could come up with more creative ideas that you could explain to the seller. You know, if your seller is a veteran, you may see if they may be willing to do a wraparound mortgage, do some seller financing. But then if they start asking for details on how to set that up, I don't know, you'd have to get their attorney involved in that then. And you'd have to get an attorney that's knowledgeable about it. Okay, but it's an idea. You could start exploring that, not with your first clients necessarily, but talk to some attorneys when you start dealing with the clients and they have attorneys and stuff, start having conversations with some of those attorneys. Hey, I was just wondering, would you know how to set up a wraparound mortgage? Because I'm looking at different ways of creative financing, but I'm trying to build a team of people that are knowledgeable in it. And, you're a real estate attorney. You just want to see if you have knowledge about it or if you know how to set this up, and then you start building up your team. So for future clients, perhaps now you can start putting things together. And now you're going to be an agent that got their stuff together, right? And you're doing things that other agents aren't. Because most agents are just out there going, how do I get buyers? How do I get sellers? Now you're like, well, not only am I getting buyers and sellers, but I'm coming up with creative financing ways that we could get more buyers for our sellers by offering sellers financing. And then the sellers are also making more money off of it because basically, essentially, the seller becomes the lender. Ooh. Can they make a lot of money by offering loans? Remember how much money the bank made in that 5% interest rate loan over 30 years? Right? You're getting the seller some extra money too. All right. Open-end mortgage. Borrower never actually closes on the loan. They could actually use the loan as a bank account kind of, or as a line of credit pretty much. However, the lender has to agree to it, but they don't have to allow it. Okay, so basically they never close the loan out. As you build up equity in a loan, you could drain it out. You don't have to go filing for a new loan. You could just take it back out of that loan. But the lender can say no. Okay. But that's an open-end mortgage. Mortgage is never closed out. It could be used kind of like a line of credit. All right, nothing really to highlight with that. Construction loans are considered to be, new construction is one thing, and rehab loans are another thing, or improvement loans. Okay, so when they're mentioning here a construction loan, if you were to read the whole paragraph, it talks about construction and rehab loans and all that, but exams refer to the construction loan as a first loan for the construction to make new, the new home. So it will be the only loan on the home. So it's a first loan and not a second for exam purposes. You got me? You follow? You could have loans that are first loans and second loans and all that. But as far as exam goes, they consider a construction loan the first loan and the only loan on the home. So it is considered a first mortgage for exam purposes. That will help you greatly. Okay. So let's highlight the term construction loan, and right above it, first loan, not a second. Just like I have written here, first loan, not a second. This way, save you a couple writing a couple of words there. First loan, not a second. Okay. And then we're going to go down 2 lines and we're going to highlight a construction loan. In a construction loan, the lender disperses the loan proceeds while building is being constructed. Remember how I explained to you how the FHA 203K loan works? Construction loans work the same way. Regular construction loans, not from the FHA, work the same way.
Can you repeat what we're highlighting?
The last paragraph on page 254. You're going to highlight the title, construction loan.
Right.
Then you're going to go down 2 lines, or the next line, go down 1 line, and at the end of the line, you're going to highlight under a construction loan, the lender disperses the loan proceeds while the building is being constructed.
Thank you.
Okay. Now, sale leaseback, the next thing. Let's stop right here. Let me stop here for a second. Sale leaseback. Tell me what it is. Don't look at the book. Look at me. Tell me what a sale leaseback is. Listen to the words.
Sale?
Listen to the words. Sale leaseback. Tell me what it is.
You're selling your lease back.
You're selling the property and then you're leasing it back from the new owner. This is common in commercial real estate. When the owner wants to raise money, instead of taking out a loan, You're sitting on your equity. You don't have to take out a loan. So let's sell the commercial property that we're using for our business purpose, and then we're going to lease it back at some long-term favorable lease terms. You don't have to agree to the sale if you don't get the terms that you like. So who's holding all the cards here in this deal?
You are?
The seller is,
The seller?
right? You don't have to sell it unless you get a sale that's favorable to your terms. That's called a sale leaseback. Okay. It's a way for a business owner to generate, to come up with capital for their business, for maybe expanding or upgrading their equipment or whatever reason they need working capital for their business. They could sell the property and lease it back from the new owner, hopefully at a favorable lease terms for a long period of time. So that purchaser is going to be an investor that owns commercial property. They're going to become the landlord, right? All right, so let's highlight sale leaseback, sometimes used as a means of financing large commercial or industrial plants. Then go down 1, 2, 3 lines and highlight the buyer becomes the lessor and the original owner becomes the lessee. So I got that on this line. You see this line on the slide? It says the mortgagor becomes the lessee. So you could get this as a question on exam. What type of buyer-seller arrangement where the mortgagor becomes the lessee? Sale leaseback. Right? Let's see. The next paragraph you could skip to just talk about sale leaseback some more. And the following paragraph talks about a land contract, which I believe we spoke about already once before in chapter 11. What's a land contract? It's a type of seller financing where the seller does not turn over the deed to the buyer until the full amount owed is paid.
Like rent to own.
Yes. So let's highlight a land contract, also known as an installment sales contract. And then right underneath that paragraph, it's a type of seller financing. See chapter 11, page 190. That's where we first saw it in chapter 11, at the end of chapter 11. So it's referred to as an installment sales contract. The buyer makes monthly installment payments, but the seller does not give the deed to the buyer till they pay off the full amount owed. And even though the buyer is not yet the owner till they pay off that full amount owed, they do have a financial interest in that property called equitable title. But don't confuse it with don't confuse a land contract with a ground lease. What's a ground lease? It's one where it's a long-term rental of the land that they construct a building on it.
They're going to build a building on it. Yeah.
Yep. All right. See, you get questions on these two, or you'll have both of these answer options for a question asking about, and the land contract and ground lease will be the possible answer options. So you have to understand what a land contract is. It's a type of seller financing. A ground lease is a situation where somebody rents the property and erects a building on it. Okay, some other types of buyer-seller financing arrangements are, we have a lease option. Wait, what do we call contracts that have options in them? They're unilateral contracts. And who can prepare those? Only attorneys can prepare contracts that have options in them. So option agreements must be prepared only by attorneys. So a lease with an option to buy is an example. We cannot prepare these contracts, only an attorney can. So how do these usually work? Well, a tenant is leasing a property and they negotiate in advance with the owner a purchase price by a predetermined deadline that they have to exercise their option to buy or not. And then we have a lease purchase. That's a bilateral contract. You're leasing the property and you're definitely going to buy it at a predetermined deadline by at a predetermined purchase price. Okay, then it talks about primary mortgage market. What's a primary mortgage market and the secondary market? Primary market is where loans are made to buy real estate. Secondary market is where those loans are resold to investors. Okay. So let's see, if you wanted to highlight that here under sources of real estate financing, primary mortgage market, you can highlight the primary mortgage market, lenders who supply funds to borrowers as an investment for the purpose of reselling them to investors as part of what is deemed the secondary market. So who do you get loans from to buy real estate? Your local banks, investors, insurance companies, mortgage brokers, and credit unions. What's the difference between a mortgage banker and a mortgage broker? Anybody know? Mortgage banker works for one bank writing loans. Mortgage broker works with many banks and private investors to get loans. That's the difference between a mortgage broker and a mortgage banker. Mortgage banker works for the bank. Mortgage broker works with many banks and investors. Isn't this one interesting though? Insurance companies, what do you mean? Insurance companies gives loans to buy houses or properties? Yes, insurance companies have a boatload of money just sitting around.
Huh.
You guys got car insurance? You guys have
Yep, that we
homeowners
never
insurance? You guys have
Mhm.
life insurance? Have
Yep.
you used any of these insurances up, or have you just been paying into them over the years?
Just been paying.
Just been paying, yeah.
And these insurance companies just been collecting. So they got a lot of money, cash on hand, just sitting around. Why just leave it sitting around when you could use your money to make more money? Let's lend. So that's what insurance companies do. They do investments for large investments. Usually they're not going to lend to you to buy a house. They do more on the larger lending terms, or they supply the funds for lending. So you get mortgage brokers that they get the money from investors. Some of those investors are insurance companies or private investors elsewhere who are investing their money into these loans. Teaching you about the back end of stuff, how it works a little bit. Don't need to know that really for exams. So let's turn to page 256. Applications for credit. On page 256, they talk about mortgage bankers, mortgage brokers, and credit unions, by the way, as sources of funding. Under applications for credit, how does it work? Let's look at my slide here instead. First step, you get a buyer. What do you do before you show them anything, before you turn your computer on?
See if they're pre-qualified.
That's it. You got to get them pre-qualified for a loan. Get them on the phone with a mortgage rep. Let them check their credit and make sure that they don't got a 500 credit score, so you don't got to waste the electricity to turn on your laptop or your your computer or whatever, right? Because they ain't buying nothing with a 500 credit score. All right, it ain't happening. what's the minimum credit score requirement to get most loans that are not considered subprime and risky?
620.
620. That's right, 620. All right, so anything below 620 is considered subprime. It's a risky loan. It's a bad credit score. Okay. By the way, you guys monitor your credit scores?
Yes.
You guys can download an app called Credit Karma. Let me see my financing stuff. Okay. You guys can get an app called Credit Karma. It's free. It's a free app, and it'll update you on your credit score regularly. Now, it's not going to give you your hard score, but it's pretty close. All right. And it updates you on your credit scores locally. You know, you may have a credit card that gives you your credit report or credit score for one of the credit companies. Credit Karma gives it for 2 of them. I install it, I check it out. It gives me notifications and updates every now and then. So I know if somebody's messing with somebody's using my social security number perhaps to get additional credit. You know, it's a way to monitor it without having to pay for, you know, like LifeLock or something like that, right? Yeah. And my credit score is still all right. It bounces around. It goes up, it goes down. I probably got a book bill I got to pay, but my credit score goes up and down. Right now, as of today, with TransUnion and Equifax, one of them is 818, the other one's 826.
That's better than good.
That ain't bad, right?
Right.
I've had it in the 840s before, though.
Wow.
Yeah. Not bad, considering at one point in time, I probably was around 550. I had a bad time with credit cards at one point. All right. With some debt. But I recovered. You know, you pay them off or you negotiate, you get your situation back together, you get it settled, and then your credit can only go one way. Don't have too much credit. Use the credit that you do have. If you have a credit line that you're not using, that's not good. You got to utilize the credit that you have in order to have a good credit score. Having a lot of credit can actually be a negative thing for your credit score. I have credit and I use it and I pay it off fully at the end of the month. The way to get a good credit score is to use the credit that's available to you. Have a long line of credit. Like if you have a long-term credit line, don't keep changing out your credit cards because you get better deals. It's good to have at least one line of credit that you've had for a long time and that you've been using. That shows your stability to the credit companies. Okay, so they look for things like that. They look for long lines of credit. What's your longest line of credit? It shows how stable you are. It looks to how much credit is available to you to use. You know, if you have a lot of credit, but you say, oh, but I don't use it all, I don't charge it all. They look at the possibility that you could, though. And that could be a negative thing for you if you have too much credit. All right. So you got to look at how much income you make versus how much credit you have versus how much you use versus how much you pay off every month. They're all factors that they take into consideration. All right. So sometimes we have to give people a little coaching on their credit too, when they're buying properties. You know, I mean, I have told people before, maybe you should get your financial house in order before you start looking to buy an actual house, you know, because you're not going to get the best, interest rates out there unless you've got a better credit score. We may be able to find you a loan, but you know, you're going to be paying a much higher rate. You're going to be paying too much in interest. You're going to say you're better off renting for a little while, getting your credit in situation in order, and then coming and shopping for a house. You know, sometimes you give that guidance to people because I don't want people getting in a bad situation financially, just getting foreclosed on later on down the road, and you know, this house cost them way too much money. It's more stress in their lives. You know, you got to look out for people too a little bit. You know. All right, so the first step in credit is you get them a pre-qualification letter. You get them on the phone with a mortgage rep. The next step is you get them to start working towards getting the pre-approval letter. Now they have to supply all the evidence that they just told them about here. Give them their bank statements, their tax returns, their credit report, bank statements, tax returns, you know, all the W-2s, whatever it is that they're looking for, and fill out the loan application with the lender, and then they get that pre-approval letter. And then all of that information that they give after the lender gives them a pre-approval. Well, how do they get the pre-approval? Well, it has all that information that needs to be verified goes to somebody that they call an underwriter at the bank. The underwriter is the person that examines those documents, and then they determine whether they're going to grant you a loan or not. They call that process underwriting. Now, if you don't know the house yet that you want to buy, but you just submitted all the information to get that loan pre-approval letter, it's still got to go through underwriters, okay? And the underwriters would then give you that pre-approval. You are approved for the loan in advance. And there's a big asterisk there. Provided that the home that you buy, do put an offer in is less than a certain dollar amount, the taxes are under a certain amount, the house appraises for the purchase price, there's no changes, major changes in your financial situation, your job, or you start going and making large purchases and stuff. As long as you don't do anything out of whack like that, you will definitely get the loan. That's why we need to advise our buyers that we work with not to go making any large purchases or lease transactions or anything like that that could affect their credit situation when buying homes. Okay. And then after that, they find a house, they put an offer in it, the house gets an appraisal, they get an inspection for at least a wood destroying insect report, which is most lenders require. And if the municipality requires a certificate of occupancy and fire inspection, the lender will also want those. They examine all those documents, and then they, through the process of underwriting, decide whether they're going to definitely give you that loan or not. If they decide they're definitely going to give the loan, they now issue what is called a commitment letter, or loan commitment. That's the loan commitment from the lender is issued in a document called a commitment letter. This is a good slide to study the process of lending. First step, pre-qual letter, then the pre-approval, then it goes through underwriting, then they issue a commitment letter. Those are the steps of lending. This one, you get a question on exam sooner than later, hint, hint. Okay, so let's go to applications for credit in the book in the second paragraph, about the 6th line down or so, where you see the word underwriting in bold on that line. You're going to highlight that sentence. Through the process known as underwriting, the lender carefully investigates the applicant's information, studying their credit history, how timely the applicant has repaid debts, credit reports, and an appraisal on the property before deciding whether to grant the loan. The lender's acceptance of the application is in a written form of a loan commitment. Highlight all that, and then underneath that, you're going to write commitment letter, called a commitment letter. The lender's loan commitment is called a commitment letter. So what do you call the lender's approval of a loan application in written form?
A commitment letter.
Commitment letter.
There you go. That'll get you the right answer on exam, hint, hint. Okay. Now, here's an example of your credit scores. They call it the FICO credit score rating. Anything less than 620 is considered to be subprime, and you're considered risky to lend because it's called risk-based lending to the lender. So if they check the 3 major credit reporting agencies, Experian, Equifax, and TransUnion, they see you have 3 credit scores. What is your credit score? They do not average them out. They just pull the one that's in the middle. That's
The middle one.
Yep. That's how they determine credit. It's not that fancy. They don't average them out and add them up, divide them by 3, and then that's what your credit score is. No, they just select the one that's in the middle. And then we're going to go over the qualifying ratios. So the last thing we highlighted was something about underwriting and the commitment letter, right, in the book. Under pre-approval of loans, it talks about, the buyer who wants to have a strong negotiation stance should work on getting that pre-approval letter. They start off by getting a pre-qual letter, pre-qualification letter, and then they graduate onto a pre-approval letter. So which one's better, pre-qualification letter or pre-approval letter?
Approval.
Pre-approval letter, right? As you can see in the previous slideshow, first one is pre-qual, then you work towards getting the pre-approval through the underwriting process, and then you get the loan commitment finally, the commitment letter, and then after that, the last stage is closing. All right, applications for credit, okay, they got to consider your credit score because they call it risk-based lending for a reason. The lender has to analyze all the risk involved, and your credit score is not the only thing that determines if you get the best interest rate on the loan. There's a lot of factors that play into it. It's your credit score is only one of them. They also have to factor in your qualifying ratios, which is your debt to income ratio, to make sure that you're not spending all the money that you're making already, because if that's the case, how much more can you afford to borrow? And still be able to live and have other expenses, for food and your car insurance and cell phone and TV and yada, yada, yada. So they need to take that into consideration to make sure people aren't overextending themselves. So qualifying ratios, you need to know what they are for exam. A qualifying ratio, they give an example of a qualifying ratio is a DTI, debt to income ratio. And what is this used for? It's used to determine the maximum monthly expense for housing that a borrower could afford to pay. PITI. PITI is your monthly maximum expense for housing, unless you also have an HOA fee, and then you have to factor that in as well. Now, typically, an example, this is only an example, it could vary from lender to lender, it could be more. An example of a qualifying ratio would be 2836. What does that mean? It means the lender, 28% of your monthly income could go towards housing, or 36% would calculate the income, your income, and all other long-term debts. They run the numbers by comparison both ways, and whichever one is lower is which one they go by. Sometimes they could go for as high as 48 on that last one. Depends on the lender. So in the book on page 257, where it says qualifying ratios, I'm going to dictate something for you to write there, a nice note for you to write. It's a long one, so write small. Basically, I'm telling you what's on this slide here. I write, an example of a qualifying ratio is a DTI, debt to income ratio, used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. PITI. All right, so that's a lot that's got to go in there. So if you got enough room for me, I wrote small and it took 3.5 lines. All right, so I'll dictate it again. Ready?
Yes.
Okay, so I'm waiting for you guys. I don't know if you guys are ready. You're not getting pens or if you're gonna write it at all. I don't know. An example of a qualifying ratio, like I have it written here. An example of a qualifying ratio is a DTI, debt to income ratio. So an example of a qualifying ratio is a DTI, debt to income ratio. Let me know when you guys have that written down. An example of a qualifying ratio is a DTI, debt to ratio.
Got it.
Okay. Used by lenders to determine, as you can see on the next line, used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. PITI. Basically, you're going to write this next bullet point down. used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. Pity. And let me know when everybody's got that.
Got it.
Awesome. All right. So you do need to know this for exam. I know you're going to get a question on it sooner than later, and you'll probably get one on it later too. What are qualifying ratios used by lenders to determine the maximum monthly expense for housing that the borrower could afford to pay? It's not used to determine how much they could borrow. It's used to determine how much the borrower could afford to pay monthly based on their current income and expense ratio. All right. Now, lenders can use that ratio now to determine how much you could afford to pay monthly. And then remember, we had that mortgage factor chart that determines how much your monthly payment would be based on the amount borrowed. Well, they could do some reverse engineering here to try to figure out, well, if you could afford to pay this much monthly, what's the maximum you could afford to pay monthly? So I'm sure they have a chart. I'm sorry. If that's how much you could afford to pay monthly, how much could you afford to borrow? I'm sure that they have a reverse chart of the mortgage factor already worked out. So based on your monthly payment, the maximum monthly payment you could afford to pay, they could see right off the bat, boom, how much you could borrow. All right. So they have to do a little reverse engineering there. That's how that works. All right. Now, the government has some influence in lending. We have the Federal Reserve System, which ironically is not a part of the government. It sounds like it is, right? The Fed sounds like it's part of the government, isn't it? Or doesn't it? It's not.
Yeah.
It's not. The Fed, or Federal Reserve, is actually all the bank leaders that do business in the United States, all the bankers that do business in the United States that lend money, that loan. It's an organization of all the bankers, the Fed. Has nothing to do, in no way, shape, or form is a part of the federal government. Okay, so it's funny that they use that term, Federal Reserve, right? So the purpose of the Federal Reserve is they all get together and they talk with each other, smoking cigars and sipping wine in their secure building, armed with armed guards all around. And they basically decide, are they going to be giving, what the interest rates that they're going to be charging the public are today. We want to charge them as much as we can as they smoke their cigars and sip their, not wine, whiskey or, triple age, whatever, and they're going to charge the maximum that they could get away with doing without disabling our economy. All right. And a fancy way of saying that is they try to counter inflationary and deflationary trends to establish economic stability and maintain sound credit conditions by altering the AFR, the applicable federal rate, which lending is based on. You like the academic definition or my explanation? They're all there smoking cigars and drinking their whiskey, and how much can we get away with charging them today, eh? That's basically what they're doing, all right? Without destabilizing our economy, all right? They painted it in a little more diplomatic way here. But that's basically what the Fed is. That's what they do. So what's the government's influence with them? Well, the government they regulate banking. They regulate bankers. So they could try to argue with them or negotiate with them to try to get them to keep the rates down, for example. All right. If you noticed, as the economy was getting better, you would see in the news every now and then, President Trump has an argument with the head of the Fed about rates getting raised too fast. And then the Feds are like, oh, we can do it, you know? And, you know, so you would hearing arguments about that. Usually it's negative stuff about the president. So they would put in there, oh, you know, he's arguing and, you know, the Fed put him in his place and blah, blah, blah. And then the Fed would raise the rate. And then a couple days or a week later, they were like, yeah, he was right. And they lowered the rate again. You know, so it's the rates. It's a tricky thing to figure out. Can we raise the rates now? The better that the economy does, the quicker that, you know, that they get rate, the more they could raise the interest rates, because the more the more money that people are making, the better that they're doing, the more money they can afford to pay. So the bankers are going to charge you higher interest rates so that they can make more money off of you. All right, that's basically what's going on here. So when you hear arguments that a president, whether it's Trump or it's somebody else, you know, Obama had these same arguments too, except Obama went to the Fed to ask them to lower the rates. And they actually lowered it to the lowest rates that we've ever had in history. At one point, they lowered the AFR to zero, where the federal government was lending money to people. At the AFR, if the AFR rate was zero, meaning that the bankers aren't making any money while they're lending, they still gotta charge an interest rate, because there's some money to be had there for the banks and for the other people getting paid. There's some money that has to be coming in still, as well as the interest that's paid to the borrower, to the people's money who's being used. So the lowest that we've seen the rates, it actually dropped down to 3% and even the high 2s. Okay, that's the lowest ever, and that's if the AFR is zero, and we've never seen it at that before. Okay, that's critically low. Now our economy's been improving, so the rates have been rising, but slowly, because we're not trying to jack up everything and lose the ground that we've been gaining by the improvements in the economy. So that Fed is playing a touchy game of how much can we get away with raising the rates on without destabilizing the economy and you know, making us stumble in our gains that we've gotten. All right, so that's the influence that the government has in that regard. And then the government also has influence through secondary market through Fannie Mae and Ginnie Mae and Freddie Mac. Well, Fannie Mae, their stock symbol is FNMA. I could actually turn the page. And on the top of the first page of 258, the top line, we could highlight that loans are bought and sold in the secondary market after they've been originated. Where they originated?
Secondary market.
No. Loans are bought and sold in the secondary market after they've been originated. Where have they been originated? Where are loans originated?
The primary market?
The primary market. So you have a primary market, that's where loans are made to purchase real estate from lenders. And the secondary market is where they resell those loans to investors. Sometimes they're other banks, sometimes they're investment groups. And here are some of those investment groups: Fannie Mae, Ginnie Mae, Freddie Mac, and there's a lot of others out there too, BlackRock and others, you know. So what they do is they buy these loans. They get packaged up by your local bank that writes a bunch of loans. They package them with a lot of other loans. The good loans with enough bad loans to get the bad loans off their books so that they don't risk their banking licenses, right? And they sell them to the investors. They call that mortgage-backed securities. You guys ever hear that term before? Mortgage-backed securities? They're basically packaging up enough bad loans with the good loans to make it the pot sweet enough that an investor is still willing to buy it. They call them mortgage-backed securities to get them off the books. So Fannie Mae is the largest purchaser of those loans in the secondary market because they buy 1 out of every 10 loans that's out there. That's a lot for only one company, right? Fannie Mae's stock symbol is FNMA. And if you were to sound it out, FNMA, right? FNMA, right? So sometimes on a state exam, they may give you some of these stock symbols instead of telling you what they are, and you need to be able to figure out what they are. FNMA stands for the Federal National Mortgage Association. That's what Fannie Mae used to be called. It's operated under a shareholder-owned company under a congressional charter. That's a fancy way of saying that the government now owns it. It used to say, if you have older versions of the book, it used to say a privately owned company. Now it says a shareholder-owned company under a congressional charter. Congressional charter, Congress? Ah, yeah, because all the bailout money that we dumped into them, we pretty much own them now. So this is why when President Obama left office, he changed those criteria for dropping the insurance on the FHA loans, because he's trying to get people off those loans. He's trying to change the rules and the criteria and stuff to make it more stable, so that these companies don't have as many defaulting loans, and to make sure that more money's coming into them, to make them more sound, so that investors will buy the group again, and it's no longer going to be run by we, the people, right? Now, when they change the criteria for the loans that they're about to purchase, your local banks change their criteria to match, right? Especially if they're the ones that are buying 1 out of every 10 loans that are out there. If Fannie Mae will buy the loan, you'd be pretty sure that other investment groups would too. We call loans, those lending criteria that Fannie Mae has. When a loan meets all those lending criteria, it's referred to as a conforming loan. A conforming loan conforms to Fannie Mae's lending guidelines for loans they're willing to buy. Or another way of saying that is conforming loans is a loan that meets Fannie Mae's lending guidelines, which you should not confuse with a conventional loan. What's a conventional loan? It's a loan directly between the borrower and lender with no third-party involvement. There is no third parties lending guidelines like Fannie Mae that they pay attention to, because they're lending their own money. You get them from portfolio lenders who are planning on keeping those loans in their own investment portfolios. So this is often two loans that get mixed up: conventional loan versus a conforming loan. What do we call a loan that meets Fannie Mae's lending guidelines?
Conforming loan?
A conforming loan. So what do you think we call loans that do not meet Fannie Mae's lending guidelines?
Non-conforming loan.
Very good. They're non-conforming loans. And so Fannie Mae, you know how the FHA has lending limits for the maximum they'll loan for a 1 to 4 family home? Any loan that's over that amount, what do we call those loans? There's actually a name for it. They're called jumbo loans. They're jumbo in size. So a non-conforming loan is a loan that does not meet Fannie Mae's lending guidelines for loans that they're willing to buy. So who do we get loans from that are non-conforming to Fannie Mae's lending guidelines? You get them from their conventional loans. You get them from portfolio lenders because they're more flexible with their lending guidelines. You would go to the people who maybe don't meet certain lending criteria for different loan programs. Maybe those criteria are the house is over an amount that the FHA will insure. Or, and what do we call those loans? We call them jumbo. You see down here, a jumbo non-conforming loan. Who do you get them from? Portfolio lenders. I gave you a list of some portfolio lenders to start you out there a little bit. So under Fannie Mae, let's go to the second paragraph, and on the second line of the second paragraph under Fannie Mae, we're going to highlight loans that meet Fannie Mae's guidelines are called conforming loans. They conform to Fannie Mae's lending standards, their lending guidelines for the loans that they're willing to purchase. And where it says Government National Mortgage Association, that's Ginnie Mae. I got this giant moth flying around my room. All right, there he goes. Ooh. I'll kill him later. All right, so we got this Government National Mortgage Association, Ginnie Mae. You get right next to that, Fannie's ugly stepsister, F-A-N-N-I-E, Fannie's ugly stepsister. Because you got to remember those two are related, right? Why do we call her Fannie's ugly stepsister? Because Fannie Mae, or Ginnie Mae, or their stock symbol GNMA, Ginnie, so you could sound that one out too. That stands for Government National Mortgage Association. They buy loans that are riskier loans, or loans where people didn't put as much money down, or their credit was less than perfect, right? And Freddie Mac will buy loans on the secondary market from portfolio lenders, the conventional loans. Sometimes if they need to resell some of those loans to get some funds, they'll buy them from them. All right. All the way down the bottom of the page, we're going to highlight the last two lines that say, under non-conforming loans, that say, loans higher than the secondary market limit are known as jumbo non-conforming loans, and the borrower who wants to place one would search for a local lending institution that is in the market of making portfolio loans or portfolio lenders. So I call them conventional loans or portfolio loans. You get them from portfolio lenders. And loans that are larger than those that meet Fannie Mae's lending guidelines are called
Jumbo loan.
Jumbo loans. That'll probably be on exam. So you need to know the difference between conventional loan and conforming loan. What a jumbo loan is. And then we have Regulation Z. You guys already have stuff highlighted here?
Yes.
Do you guys recall what Regulation Z is? It's the law that requires full disclosure and truth in advertising when talking about financing in an ad, if certain triggering terms are used in that ad. All right. Regulation Z does not apply to commercial loans or cash purchases. Where is it? I got a slide just about this. 1 second. There you go. Yeah, I got it all in one slide coming up. All right. So Regulation Z implements the Truth in Lending Act. It requires credit institutions to inform consumers of the true cost of obtaining credit when certain triggering terms are used. It doesn't apply to commercial loans or cash purchases, only applies to financing, consumer financing. Yeah, you know what? This slide is best. It has everything on it. Of all these other slides, it's all, I put it all together into one slide. Let me just make sure everything's there. Yep. This one slide has all that information from those 4 previous slides, pretty much. So Regulation Z is a federal law that implements the TILA, the Truth in Lending Act, that requires full disclosure when talking about financing in an ad if certain triggering terms are used. If you wish to take a picture of this, snap a picture. This is a good slide to study everything you need to know about Regulation Z. Now, what are the triggering terms that would be used in an ad that would trigger the full disclosure requirement? If you mention financing payment amounts, like a monthly payment in an ad, if you quote an interest rate a down payment amount, or a term, like the number of years or number of payments. These are the triggering terms that would trigger the requirement of full disclosure, according to the Truth in Lending Act. So what is full disclosure? Well, first of all, you would have to state one of these terms. You could not just indiscriminately promise financing to everybody in an ad. So you have to discriminate by saying to those who qualify or to a qualified buyer. Otherwise, if you don't state that, you're blanketly advertising to everybody who sees this ad can get the loan. And that's not the case. So we have to qualify them by saying to those who qualify or to a qualified buyer. But I believe the term that they use on exams is you cannot indiscriminately promise financing. You must discriminate to those who qualify or to a qualified buyer. Okay. And then in addition to that, you have to disclose all the terms. They would be the APR. That's the annual percentage rate, which is different from the interest rate. The APR is always a little bit higher. It includes all the one-time ancillary fees that are non-reoccurring, like an application fee or an appraisal fee, those fees that are required in order to get the loan but are not reoccurring. If you were to factor them into the interest rate over the life of the loan and then break it down on an annual basis, what the interest rate would be, that's the APR, annual percentage rate. Okay, I gave you guys a little lesson there to know. The APR is always a little bit higher. It's a tick higher than the interest rate that's advertised. But it's basically the effective rate that you pay when you factor in all those one-time payment costs associated with getting a loan. Down payment amount must be stated if one is required, and the term. That's the number of payments or the number of years of repayment. And Regulation Z does not apply to businesses or commercial loans or for cash transactions. Now, what are the penalties for violating an administrative order of Regulation Z if you don't put these disclosures in the advertisements and you talk about financing in an ad? $10,000 per day that violation that ad that does not comply with the law is out in the public domain. The fine is $10,000 per day, plus any attorney's fees if there are any that are needed to be paid. And so every day the ad is in the public domain, you got to pay 10 grand a day. And willful violation is a misdemeanor for an additional $5,000 fine and possible 1 year imprisonment. So, anybody not have anything highlighted on this page under the Regulation Z that needs me to point out what to highlight?
If you could point it out anyway, I have like
Sure,
one line.
sure. Under Regulation Z on the first line, we're going to highlight the Truth in Lending Act is implemented by Regulation Z. Then on the last line in that same paragraph, we're going to highlight does not, or highlight or underline, does not apply to cash transactions or business or commercial loans. Then on the next line, next paragraph, we highlight Regulation Z requires that the borrower be fully informed of all financing charges. Then highlight the last sentence in that same paragraph. The rules do not apply to home equity lines of credit, reverse mortgages, and land loans secured by a dwelling not attached to the property. Basically movable dwellings, mobile homes. Maybe I could add that in here somehow. I said it does not apply to business or commercial loans or cash transactions. You know what, I'm going to add to this. I'll be more complete in my definition on this slide. Or cash transactions, right? reverse mortgages, land loans, with removable dwellings slash mobile homes, right? Dun, dun, dun. Save, and here we go. Oh, you guys may not be able to see this right now. Here, let me put that back. I made some adjustments. I added does not apply. Okay, so I just changed this up a bit. I said does not apply to business or commercial loans or cash transactions, reverse mortgages, land loans with removable dwellings, which are basically mobile homes. Okay. And then in the next paragraph, the third paragraph down, I just put a highlighted box around the whole thing, which I'm not sure if this is in version 13 book, but 14, it says, TRID requires delivery or mailing of early disclosures about proposed loans within 3 business days of the completed mortgage application. Until the disclosure has been made, the lender cannot charge any fees except for a credit report. A loan application is considered complete when the prospective borrowers provide the address of the property, the loan amount requested, the estimated property value, the names of the borrowers, and their social security numbers. In other words, aliens, when aliens is present. That's the acronym for remembering all those items, aliens. That's when the borrower supplies all that information to the lender, the application is considered to be complete. And then they have to start giving disclosures, right? What do they need to give? What does the lender need to give to the borrower within 3 days of aliens?
Disclosure?
What disclosure?
The closing disclosure, the CD?
No.
No.
They got to give the LE, because this is at the beginning of the transaction. The closing disclosure is towards the end. So they have to give the loan estimate within 3 days. They got to drop it in the mail to them. And they also got to give something else within 3 days. The toolkit, the Your Home Loan toolkit on how to shop for loans and compare loans, etc. Right? The CD, they must give at least 3 days before closing. Okay. The LE has to be given within 3 days of their completed loan application, aliens. And there has to be at least 7 days before the closing and the time that they gave the LE. Now you may be thinking, well, of course there's going to be more than 7 days. Well, not necessarily, because under certain circumstances, the lender may be required to reissue a new loan estimate if certain things change, certain terms change in the loan. All right. So at the bottom of the next paragraph is just a link to the TRID disclosure. Let's read the last one. The consumer must be notified that they have the right to cancel a transaction even after the loan application has been made and the disclosure received. This allows the consumer to compare various lenders and offers, because a lot of times in the past, what lenders used to do a lot of times, and it's usually the mortgage reps, the local mortgage reps, not the main banks. The local mortgage reps know that they could lose your business if you shop around and get a better deal elsewhere. So they try to discourage people from shopping around for loans by saying, hey, if you shop around for a loan, they're going to run your credit again, and it could screw up your credit and you won't qualify for a loan anymore. So don't go shopping around for loans. I highly discourage you from doing that. All right, that's not true. Is it going to have an impact on your credit score? Minimal. If you shop around for several loans, they run your credit score several times. It may affect your credit score a point to 3 points. And if a point or 3 points is going to make or break you on your credit score on getting a loan, maybe you should get your financial house in order and improve your credit score more before you start shopping for a house. You know, otherwise, shop for a home, shop around for a loan for the home. I'm sorry, and compare them. It's not going to kill your credit. That's not true. But a lot of lenders or a lot of mortgage reps tell people this, and they still do even. But if they were to look at these disclosures and actually read the paperwork the bank sent them, but even though they're getting all these disclosures, people tend not to read everything. You know, they're looking for a house. I want to go see houses. I don't want to read paperwork from the bank. So a lot of times people don't even read this stuff and they just listen to whatever their mortgage rep tells them. So our job should be just to point it out to them, you know, hey, you could shop around for a loan. It's not going to negatively affect your credit score in such a way that you're not going to be able to afford a loan unless your credit score is shit to begin with, right? Don't repeat that, Birdie. Okay, let's see. Turn the page. So that's everything that you needed to highlight there under Regulation Z, okay? I already explained what an APR is, and that's what the next section is talking about. Oh, wait, no, we're not done with Regulation Z. Regulation Z is still continuing. There's a section here called 3-day right of rescission on the next page. We're going to highlight the right of this right of rescission does not apply to residential purchase money first mortgage loans. Okay. So remember the rights of rescission. What's the right of rescission for mortgage loans to buy real estate for purchase money mortgages? 0. What is the right of rescission for loans to refinance property you already own? 3 days. Okay, that's basically what that's saying there. Now, under advertising, they're giving you examples here in the book. After the first paragraph, there's a line here I want you to highlight that says, Regulation Z applies to all credit advertising if any one of the following triggering terms is used. Everybody getting this? Okay.
I'm sorry, what paragraph?
You see where it says advertising?
Yes.
The paragraph after that, it says Regulation Z applies to all credit advertising if any one of the following triggering terms is used. You're going to highlight that sentence. And then you're going to put a highlight, you're going to highlight just straight down, just highlight the first four bullet points. Then you're going to skip those next 3 bullet points. And you're going to highlight the sentence that says, for example, full disclosure would be necessary if any of the following terms were used. And then highlight those 3 bullet points that say 30-year loan available, payment of $1,432, including principal and interest, or only 5% down. Okay. And then what I did is those first 4 bullet points, I'm going to connect to that next group of highlighted bullet points with an arrow. Because one of them is the directions that says what it applies to, and then the next one gives you examples of them. See I connected them? And then on the next page, we're going to highlight under penalties that the penalty for violating an administrative order enforcing Regulation Z is $10,000 for each day that the violation continues. Now let me continue reading. It says a fine of up to $10,000 may be imposed for engaging in unfair and deceptive practices In addition, a creditor may be liable to the consumer for twice the amount of the finance charges for a minimum of $100 and a maximum of $1,000, plus court costs and attorney's fees and any actual damages. Highlight, willful violation is a misdemeanor punishable by up to a fine of $5,000 and 1 year imprisonment or both. And all of these details I have on this slide in one slide instead of 1, 2, 3 pages. Which one's easier to study from?
Slides.
Okay.
If we mainly just study from the slides, will we be fine?
Yeah, but look at this. There's a bunch of other slides in between. It's a lot of bullshit. And then I put it all finally on one slide. I condense it all to one slide. So, I mean, if you could delete this slide, delete this slide. But all of these slides kind of like explain the same stuff though.
I mean, overall though, like the whole class, if we just study mainly the slides, will we be fine like that?
The main slides that I pointed out for you, they'll be very helpful, but I don't think I have slides on everything that you needed to study though.
Oh, okay. Okay.
So I would also go on the highlights in the book. And then some of the things that are probably a little more complicated in the book, look to my slides where I simplify them.
Okay. Thanks.
Okay. One of these days I'll get around to being able to get all the pertinent information only on the slides.
Yeah.
You know, that's a lot of work. Yeah. I'm basically writing a new book.
Mm-hmm. Yeah,
Okay.
right.
Okay, Equal Credit Opportunity Act, the next section, nothing to highlight there, but ECOA is the Equal Credit Opportunity Act. And this law basically says that anytime somebody is denied financing, the creditor who denied them financing has to give them an explanation within a certain timeline of why they were denied credit and provide them a free copy of their credit report from the 3 credit reporting agencies. Right? You guys are aware of that? You ever apply for a credit card and you got denied it, and then they had to send you a link where you could claim your credit report for free from the 3 credit reporting agencies? And they had to send you an explanation in the mail. You probably got it within the next week.
Yeah.
Okay. Well, that's from ECOA. ECOA requires that. They want to make sure that that creditors are not discriminating by not giving people credit because of their race, color, religion, national origin, sex, marital status, age, or dependence on public assistance. So they want to give people to give explanations. Now, if you guys are offering financing and ads, well, that has to deal with Regulation Z. But let me see. Do we ever use people's credits that we could deny them something? In real estate? Do we as real estate agents ever deny people because of their credit?
No.
No.
No? What
We
about
can't.
what about renters? Do we
Yeah,
ever
like
run
a
their credit?
lease. A lease, but doesn't that like fall back on the landlord?
Wait a minute. Who ran their credit?
Well, it depends.
Who's denying them?
Whoever ran the credit.
I
No,
never
the landlord.
deny people leases because of their credit. I'll run their credit, but I'm
Right.
not going to deny them because of their credit. Look, if their credit is screwed up, I'm sure their debt to income ratio is screwed up too. I'm sure their references are screwed up too. I'm sure that they have a history of late payments and all kinds of other bullshit too, right? So I never deny them because of their credit. I deny them because of their payment history. I deny them because of their debt to income ratio is probably off. You know, I deny them because they're probably going to have lousy references. And then this way I don't got to deal with the ECOA bullshit. You see how I do it? And there's a better way to distance yourself too. Here, let me show you the better way to distance yourself. Some of these credit reporting agencies, they now have what we call credit scoring systems. Just write that down. You guys can Google it yourself to look and see. Look at the TransUnion, Equifax, and what the other one, Experian. One or two of them have, and there's probably other sources out there too that are offering things like this. They call it a tenant scoring system or tenant grading system. Instead of you looking up their credit and renting to them solely based on credit. This is pretty cool. I forget who did it, if it was Experian or TransUnion that did this, that they put together. It's a product that they offer where a landlord, we as real estate agents can send a link to the landlord on this, where the landlord can register their name and they could create an account for themselves. And then they could create a profile for each property that they own. Okay, if you only own one property, you only create a profile for one property. And if you have so many units, you got to put that in there, okay? And what you do is you write down what the criteria are that you want considered when selecting a tenant. Credit score, criminal history background checks, sex offender lists, current employment, rental references, debt to income ratio, and then you state on there how much weight you want to put in each one of those topics to be the determination effect of whether that you're going to grant them rental or not into their grade. Another thing is, have they filed bankruptcy? Do you want to consider that? And how long ago? And how much weight do you want to put into that? If they've had any foreclosures or anything like that, do you want to put weight into that? Do you want to consider that? How much? And all these factors get combined into your final score for a tenant. And look, for any one of these things, you could just select automatically disqualify. Like if they're on a sex offender list, you could be like automatically disqualify. Or you could just say, that's like 3 negative marks against them, And then it'll give an overall score or grade for the tenant. So sometimes it's called a tenant grading system or a tenant scoring system. Instead of just doing credit score searches, now the landlord will have a profile for their property. And any potential tenants that want to apply to be considered for the rental, we as real estate agents just need to send them the link. And that tenant will click on it and they'll have to pay to get all those background checks done. Not us, they pay directly to the credit company that's doing the scoring. They pay for the credit score, the background checks, everything. They pay the one fee directly there. So we don't got to deal with it. The landlord doesn't got to deal with it. We don't got to deal with collecting their Social Security and all that sensitive information. It's gone directly to that. They input it themselves directly in that renter's application. And then the landlord gets sent an email report with the grade of the tenant, and they can decide if they want to rent to them or not. A plus, A minus, B plus, B minus, C plus, C minus, D plus, D minus, F, right? And then the landlord decides. So we don't got to worry about the ECOA and all these other BS laws. RESPA is the Real Estate Settlement Procedures Act. And what is the purpose of RESPA settlement statement? Which they now combined, and it's part of the RESPA settlement statement is the CD, the closing disclosure, formerly called the HUD-1. What is the purpose of that? So we got, this is a good slide to study from, by the way, for remember all those, the RESPA, the LE, the CD. The only thing that's not listed here is the toolkit that you got to give, that the lenders need to give within 3 days as well. So RESPA is the Real Estate Settlement Procedures Act. It's a federal law that ensures that the buyer and seller in residential real estate transactions involving new first mortgage loans, not refinancing and not cash transactions, have knowledge of all settlement costs for every penny in the real estate transaction. It's illegal also, I put a little note here. I should just write that as a note. Sorry. So that you could see me making this here. I'm going to remove that bullet point and just write it there as a bold note. It is illegal for anyone to get paid in a real estate transaction if it's not disclosed on the RESPA settlement statement, i.e. the CD closing disclosure, formerly called the HUD-1. This is the closing document accounting for all the money in the transaction that goes to the buyer and seller, who pays what, who's owed what in the transaction. Now, the LE, the loan estimate, is similar to the CD, but this is given right after they apply for the loan, and it tells them what those anticipated closing costs are going to be. The CD is showing them what the actual closing costs are going to be. So buyers should compare the LE to the final CD, and if the costs vary beyond certain tolerances that are defined by TRID, the lender is responsible for covering those costs. So what do we need to study? The LE, loan estimate. It's an estimate of loan cost. It replaces the old document called the GFE, the good faith estimate. It must be given to the borrower within 3 days of aliens, the completed loan application, and at least 7 days between the time the LE is issued and the closing takes place. Certain changes may require reissuing of the LE, triggering an additional 3-day waiting period too. And those certain conditions are listed on page 262, which is the next page. Before we go to the next page, you should have it already highlighted, but in case you don't, under Real Estate Settlement Procedures Act, highlight everything. The Federal Real Estate Settlement Procedures Act, RESPA, was created to ensure that the buyer and seller in residential real estate transactions involving new first mortgage loans have knowledge of all settlement costs. And then go to the third paragraph here and highlight TRID rules do not apply to the following transactions, and put a highlighted box around all the bullet points that state home equity lines of credit, mobile homes, reverse mortgages, cash transactions, and commercial transactions. I'll spell that out here again. Okay. RESPA. Put that in the wrong place. Put it up here. Does not apply to cash transactions, commercial loans, mobile homes, reverse mortgages, or HELOCs. Those are home equity lines of credit. Now let's try to expand this so it fits more, fits better, fits more better. Is that a term? Fits more better? Kids say stuff like that, right? I'm a big kid, so I'm allowed. Why are you guys so quiet? Did I say something that offended you? What did I do now?
Nothing.
All right. You guys are very quiet after lunch.
No, nothing. I was just trying to unjam my printer.
Okay. Because you know what I was going to say if you said I offended you.
Too bad.
Did you read that?
No, what did it say? Let me see. I did not mean to offend you. Oh, that's funny.
I did not mean to offend you. That was just an added bonus. All right. So loan estimates. Okay, we went over that. And the CD, that's the closing disclosure. It accounts for all the final costs. This is that RESPA. This is how RESPA, according to RESPA law, you disclose what all the settlement costs are. That is done on the, well, it used to be done on the HUD-1, but the HUD-1 was replaced by the CD. So the closing disclosure, the CD accounts for all the final costs, you know, I'll reword that to all the final settlement costs in the transaction. It must be given 3 days before the closing, before the signing of the loan documents. And the RESPA, this CD replaces the HUD-1, the RESPA settlement statements. All right. You could snap a picture of this slide. Good to study. Got a lot of good stuff on it. Mental note, take a mental picture. All right, and then we're going to turn the page. The next page talks about, all this stuff talks about that one stuff that was on the things that were on that one slide, right? Look at that. I put all these things on that one slide, didn't I? 1, 2, 3, 4, 5. Well, 5 slides. The next 5 slides is just this stuff that I put on one slide. Huh. I got to start deleting all that stuff in between, right? So TILA RESPA Integrated Disclosure TRID merged forms that lenders were responsible for delivery of these documents within certain timeframes. Lenders are liable if certain costs exceed the tolerance limitations imposed by TRID. I have that down here, don't I? All right, so TRID, what does that stand for? The reason I drink. No. TILA RESPA Integrated Disclosure. All right, and it does not apply to HELOCs, mortgages secured by movable dwellings, reverse mortgages, cash transactions, or loans for commercial purposes. TRID applies to federally related loans for residential properties only. So basically any loan that's coming not from a private lender, but any bank that's lending money whose money is kept in lending institutions, insured by the FDIC, FSLIC, insured by FHA or guaranteed by the VA, or, you know, planning on being resold to any of these, HUD, Fannie Mae, Freddie Mac, any of those. All right, these are federally related loans. All those disclosure statements, same stuff, LE about again, and that's that. Okay, so in the book, page 262, that's that intent to proceed. That's aliens, gives you the description of what aliens is, the address of the property, loan amount requested, income, estimated value of the property, the names of all the borrowers, and social security numbers. Once all that information has been supplied, then and only then can a lender charge additional fees other than a credit check. Then they can start charging application fees and other appraisal fees and all kinds of other stuff. Now, what are the things that would trigger the reissuing of a loan estimate? Okay, maybe we should make a slide for, no, I'm not going to type all this stuff right now during class, but you know what? I'm going to put a placer here. I'm going to say, changes to loan that would triggering a reissue of the loan estimate or triggering a new LE. All right. And so that's the stuff I'm going to type here. Okay. So obviously I have to put that here. And it's from page 262, from page 262. Okay. So eventually I'm going to put that there. Maybe after class later. All right. So if the consumer requests a change in the loan product, an appraisal came in higher or lower than expected, changes in circumstances that affected the applicant's eligibility, such as applicants took out a new loan, or they missed payments, or their credit score changed because of that. They went out and they bought furniture or leased a new car, something I told you got to advise them not to do. Costs changed for the services that the borrower cannot shop for, any application fees or BS like that. Interest rate changed beyond but because the consumer did not opt for a rate lock. A prepayment penalty was added, although in New Jersey, no prepayment penalties allowed. We need to know that for exam. Loan product was changed, or the APR changed for a fixed rate loan more than 1/8%, or an adjustable rate loan more than 1/4%. That would require the triggering of those circumstances, would require triggering of a reissuing of a new LE, the new loan estimate. And if you go to page 267, you guys have stuff highlighted there, changes that would not trigger the reissuing of a new LE. Unexpected discoveries during the final walkthrough, and those final adjustments at closing for taxes and meter readings and stuff like that. And then you should have LE loan estimate, right? You have something highlighted there and written next to the title, replaces the GFB good faith estimate.
Yes.
And then you have something highlighted there as well?
Yes.
That the LE must be delivered or placed in the mail no later than the 3rd business days from the completed loan application, right? And then the CD, the closing disclosure, replaces the HUD one. And then you have the second sentence highlighted, the CD must be delivered to the consumer no later than 3 business days before the closing and the signing of the loan documents, right?
Yes.
All right, and then that concludes chapter 15. And now we can do the key terms to review and start chapter 16, which is loaded with terminology about valuation of property and how we do the different ways to value property, how the different approaches that an appraiser goes over, and the theory and all that stuff. All right, so let's do the key terms. There's 2 of them for this chapter.
Victor, I have a quick question. I'm so sorry to interrupt.
Okay, no, you're not interrupting at all. This is your class. You can ask.
These business days, it says like Saturday, it's Monday through Saturday?
Well, there's 2 definitions that exist for what a business day is.
Right.
One is every day except for Sundays and legal holidays, federal legal holidays, which one definition is every day during the week, Monday to Friday, and it does not include federal holidays or weekends.
Right.
Another definition includes every day except for Sundays and federal legal holidays. So basically, there's 2 definitions. Sometimes Saturday is included, sometimes it's not. So it depends on the lender when they're open for business.
So that could be a trick question.
So there you go. It makes it clear as mud for you, right? What's a business day? The law gives you 2 definitions now. No, they're not going to ask you that because it would depend on the lender.
Okay, good.
You know,
Yep. Got it.
They can't pose a question to you unless they pose all the different rules of that particular lender, and they're not going to get into that.
Okay. Cool.
But in reality, this law created all these new stupid rules like this, you know? All right, so let's go over key terms to review. Uno. Are you ready?
Yes.
All righty, then let's get started. All right, is your birdie listening? Get your ears on. Get your ears on. What? Get your ears on. Come on, Polly. Polly, get your ears on. All right. Agent who brings together a lender and borrower for a fee.
Mortgage broker.
Mortgage broker.
It is. 11 is A. A bridge or swing loan for short-term financing before sale.
Interim financing.
8 is B. Interim financing. Cooperative organization for members who save and borrow.
Credit union?
Credit union. 3 is C. It's a nonprofit bank, basically. Federal Home Loan Mortgage Corporation warehouses packages of mortgages.
13, package mortgage.
Freddie Mac. Freddie Mac.
Oh, wait.
5 is D, Freddie Mac. If you look at the first letters of all of them, that's the stock symbol, FHLMC. That's the only one you can't sound out. That would be Freddie Mac. 5 is D. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae.
Fannie Mae. 4 is E. Government National Mortgage Association pools mortgages for investors.
A banker. Mortgage banker.
Jeannie Mae.
Ginnie Mae. Look at the first initials on them. Government,
yeah.
G,
Oh,
National,
yeah.
and Mortgage and Association, GNMA. Sound
Right.
it out. GNMA, right? 6 is F. A mortgage that provides possibility of further borrowing.
A construction loan.
Open-end.
Construction loan.
Open-ended mortgage. 12 is G. 12 is G. Mortgage covering both real and personal property.
Package. That's
The package deal. 13 is H. Package mortgage. Agent who makes real estate loans.
The banker. Mortgage banker.
10 is I. A loan higher than those usually bought by the secondary market.
Jumbo.
Jumbo, they are jumbo in size. So 9 is J, and it's a real thing. You guys got to study that. I can't tell you how many people they go to take the exam, they get a question on that, and they were like, I didn't think that could possibly be the right answer. I mean, it was too obvious. A loan larger than those that Fannie Mae's lending guidelines are. Jumbo is kind of like too obvious. So I thought that was the fake answer. I'm like, no, that is the right answer. You didn't study because jumbo. It is the obvious answer right there. Okay, mortgage covering both. Mortgage covering more than one parcel or lot.
Blanket.
It's a blankie. 1 is K, the blanket mortgage. Additional financing for homeowner, usually a type of second mortgage.
Home
equity.
7 is L, the home equity loan. And a straight loan for short building periods.
Construction.
2 is M. There we go.
Could you just read them like 1, 2, 3? Could you just read them down really quick? Because
Sure, I'll read them straight down the list for that
There's a
key
couple in
terms to
there.
1. K as in killer, M as in Michael, C as in Charlie, E as in Edward, D as in David, F as in Frank, L as in Larry, B as in boy, J as in Jack, I as in igloo, A as in apple, G as in George, and H as in house.
Thank you.
You're welcome. Key terms to review 2. Are you ready?
Ready.
All right. Percentage of income borrowers may spend on housing expense.
Qualifying ratio.
4 is A, the qualifying ratio. Arrangement by which seller becomes the tenant.
Sale leaseback.
Yes, 7 is B. Larger loan that does not disturb the underlying mortgage.
Portfolio loan?
A wraparound.
Wraparound mortgage. There we go. Which one is that? Larger. 12 is C. Wraparound mortgage. Lending institution that makes mortgage loans to the public. What do you call all the lending institutions that make loans to the public? They're all part of what?
Primary mortgage market.
Yes, 2 is D, the primary mortgage market. Regulates consumer loans. What regulates consumer loans?
Regulation Z,
What?
Truth in Lending.
Truth in Lending Act. Yes, 10 is E. A loan in which the investor shares payments and profits.
Portfolio loan?
An investor is going to basically lend you the money and then they're going to share in the profits when you sell the property.
Portfolio loan?
Shared equity mortgage?
Shared equity mortgage. 8 is F. A loan not intended for resale in the secondary market.
Purchase money mortgage? No.
Oh wait, is that one portfolio loan?
Reverse mortgage?
Portfolio loan. 1 is G. Words in an ad that require full disclosure of financing conditions.
Triggering term?
They're triggering terms. That's what we call those words. 9 is H. A mortgage in which the lender sends regular checks, building up debt. Ooh, that's an interesting way to put it.
Reverse mortgage?
It is. 6 is I, reverse mortgage. Process of deciding whether to make a specific loan or not. What do we call that process?
Underwriting.
11 is J, underwriting. Implements the Truth in Lending Act.
Regulation Z.
Regulation Z. 5 is K. Seller financing.
Purchase money.
Wraparound mortgage.
Purchase money mortgage is an example of seller financing, but purchase money mortgage, remember, is any loan used to purchase real estate, right?
Wraparound.
So, no, it's purchase money mortgage.
Oh,
So
okay.
3 is L. Detailed loan costs. Where do you find them?
The loan estimate.
15 is M. They're part of the loan estimate. Or the LE for short. Required items before the lender can proceed.
Aliens.
Aliens, 13 is N, and merges the TILA-RESPA integrated disclosure.
Right.
TRID. 14 is O, the reason I drink. All right. All right, let me see. We got. We did what? All right, so let me write that down a little bit. All right, so chapter 16. Let's see how many chapters we got left. Where we at? What's going on? I don't know what's going on here. Okay, we got chapter 16 left, 17, 18, 19, and 21. We already did 20. 5 chapters left to go. 16's a biggie. 19's very important too. 17's got a little stuff in it. It's about the sales of a business. 18 is the process of doing a creating a subdivision. Chapter 18 is it's a long chapter, but some of the information we've already gone over. There's a couple of new terms in there, but not many. But it's a long chapter because it mostly just does storytelling of how the process of a subdivision works. All right, so we're going to start 16 today. Hopefully we'll finish it, but I doubt it because it's got a lot of math and We'll probably save the math for morning because you guys are better at math in morning, right?
Yes.
Yeah.
Okay.
Yes.
And then we got chapter 17, which should be quick. Chapter 18, not a whole lot of stuff. It's just kind of long because of the storytelling. Then 19 and 21. So if we could do as much of this as we can today, can we do the math tomorrow? 17, we could do 18, we could get started 19. I don't know if we could finish this all by tomorrow, but we'll get most of it done. 16 and 19 are importante.
So are you saying that we might go into Wednesday? I just need to know because of my schedule.
Yeah, if we do though, it'll be like not even a half day.
Okay. Okay.
Just to finish off, okay?
Yeah, it's great.
So chapter 16 now. This chapter is going to go over all kinds of theory and appraisals and what the appraisers do, how we value properties, but it's mostly around what appraisals do, and then the different methods of appraisal and different approaches to appraisal. The theory, the things that have to be taken into consideration when valuing properties, and some terminology. And then the appraisal license types. So, you ready to dive in?
Yes.
Then let's do that. Look at that. We got some fancy screen movement up here on this show. All right. So at the end of this chapter, you're going to be able to learn all that crap that I just told you about. All right. So the real estate market. Wait, what is a market? Forget about the real estate for a second. Answer me. Talk to me, people. What's a market? What's a marketplace? It's a place where people go to buy and sell and trade goods, right? So real estate is an imperfect market in that we cannot take the goods out to the people and put it in one central place for them to shop. We got to take the client, the customer, out to where the product is to see it, which makes it a little difficult, which takes it a little bit longer to sell, a little more time required for us to realize if there is a demand or if that demand is slowing. And there's a lot of things that are dependent on real estate. Real estate affects a lot of things too, like our economy. Real estate's usually a leading indicator in an economy that lets you know where we're going. If it's based on the demand, a lot of times you could see for new home ownership. If you look at new builders, new construction from builders, if they're acquiring new land and trying to build more homes based on their demand, it's kind of an indicator of what's going on in the economy, because there's a lot of jobs dependent on real estate, isn't there? And I'm not even talking about us or the bankers or any of that. I'm talking about for a home to get built. Let's just look at the basics of it. All right. Not even taking into consideration, we have to have that there's a demand by buyers. And then if there's a demand by buyers, that's got to, the builders will get a hold of that. Then they're going to start shopping with us to try to acquire land. Then they acquire land, and then they decide they're going to build on it. Now, you have inspectors that have jobs. You have engineers that have jobs. You have architects that have jobs. Then you have the surveyors that have jobs that go out there to survey those properties. Then you have the people that are digging up the ground, the dirt diggers. They got jobs. Then you got the pipe layers and pipe fitters that lay out those sewer and gas mains and water pipes, etc. They got jobs. We got electricians that got to hook up the lines, right? Then we have what? We didn't even get into the materials really that are used in the house, right? Other than the pipes and the tools and all that stuff, the people who manufacture those tools, the pipes, the stuff that's required to hook them together. Then when we build houses, we got the contractors, the workers that are hired by the contractors to do the construction. We have the lumber yards. We've got the people who cut down the trees to make to send to the lumber yards. We've got the truck drivers that deliver the trees to the lumber yards. After it's carved into lumber, it's sold, and there's a lot of jobs there then at the store where the people go to buy the lumber. Then the what do you call it? After they send it off to the work site, the contractors are the ones that put it together. That's just the lumber and the framing. What about the plumbing that gets put in the house? What about the electrical that gets put in the house? What about the inspectors that inspect the work in between, right? What about the what about the wires, the cabling that the electricians use to install the electrical in the house? That's being made at a factory, right? What about the plugs, the outlets, you know, that you have in the plugs in your wall? That's a different product made in a different factory by different people. And then it gets packaged as well and marketed and advertised. And you see all these jobs that are connected to it. And then they get delivered. So we have drivers and truck drivers and delivery people and marketers and such, right? There's a lot of jobs before we ever get into the picture that are attributed to real estate. A lot of people don't even think about it, you know? And I'm just talking about the outlets at this point. We didn't even talk about the sheetrock or the painters or the plasterers and the, you know, all the specialists in between that do their unique work or that build the products that they're installing. Jobs, 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 right? So that's why real estate's a leading indicator in the economy. Wow. All right, so there's 5 attributes to land in order for it to have value. 1, it's finite in its supply, meaning that there's no new land that's being created. What's here is here. It's physically immobile. You can't pick it up and put it in a better neighborhood, right? Land is durable. It'll last forever. You could drop a bomb on it and it's still there. And it has its unique location and characteristics. Location, views, etc. And it's useful to people. If it's not useful to people, it's not going to have value, right? Turn the page. I don't know. I put a highlighted box around this common 5 attributes for it to have value. It's finite in its supply. It's physically immobile. It's durable. It'll last forever, practically. It's unique in its location and characteristics, and it's useful to people. Supply and demand is the amount of goods offered for sale within a marketplace at any given time during any given period. Demand is the number of people willing and able to accept those goods at any given price during that period. So when supply increases, prices will drop. When demand increases, prices will rise, right? I have a better definition of it somewhere coming up. And if we turn to page 276 for a second, we can highlight it now since we just went over it. Under supply and demand, there's supply and demand here again on page 276. We're going to highlight this principle states that the value of a property increases if the supply of such property decreases and the demand for it either increases or remains constant, and vice versa. That means, and the reverse is also possible. All right. So, value. Value is an abstract term that could have many definitions. We've learned about value before already, haven't we, a little bit? Some of the terms. What kind of value have we learned about already?
Yeah, market value, right?
We learned about market value. It's the price a ready, willing, and able buyers willing to pay based on supportable evidence of recently sold homes, similar in size, style, location, and amenity to the subject property. And then we also learned what type of value is used for taxation purposes.
Oh, we learned about land value.
Equity.
Property value? Like
What's the value that's used for taxation purposes? Assessed value.
oh,
So we learned about assessed value. We learned a little bit about market value, although we're going to dive deeper into it in this. We've heard these terms before. But so far, we've learned about the assessed value. That's a value that a tax assessor applies to a property for taxation purposes. Market value is the value of a property based on supportable evidence of recently sold homes. We're going to get into the details of what makes up market value in this chapter. And we also just learned that the word itself, value, means 100%. Remember that? We did some math problems on it. So value can be described as the present worth of future benefits. Value does not remain the same over time. It fluctuates with the market. And then I got a little tip here for you guys to take a class to learn how to better value properties instead of relying on your brokers to educate you on this. There's a class that Ottawa, OTTEAU, they have the CMA workshop. That's a great class for you to try to learn. However, if they're not given that CMA workshop at the given time, I suggest that you guys take the seasonal workshops, which will also touch on CMAs, but not as much in depth. And they'll give you some of that supporting information that comes along with it. You know, like those charts and stuff that I showed you about. How do you value a home? How much more is it worth if it has solar panels, or is it worth more if it's on a dead end street versus a busy road? How much does a pool make your house worth? Remember all that chart I showed you? No? Okay. I think it's again in here somewhere in this chapter. Let me take a look real quick in this slide. So, do I have it? Wow, I've had it in an earlier slideshow, but not in this one. That's crazy talk. Oh. Actually, I don't think it was in slideshow. I just pulled it up as additional materials, which I'm going to do right now. CMA workshop. Now they give us a bunch of guides that talks about all kinds of goodies, you know, reference guides, adjustment guides specifically for urban neighborhoods, and something called a right pricing guide. Anyway, here is one of the guides I'm about to show you, which I showed you once before already. This is the CMA workshop that they have, right? They give you, see, this one's from a class I took in 2015. That's Jeffrey Ottawa. He's the president there. His group, they aggregate information from many sources and data sources. Information, everything about the job markets, because that's important in their analyzing where people are moving from and why they're moving and where they're moving to. And they aggregate information from all sorts of data sources, and they put together these comprehensive reports that help us not only value properties, but to determine if people are going to be moving and from where and to where, et cetera. And things and that attribute to people's moving. There's a lot of factors that could play into the role. Some of them are not as expected as others too. We had a lot of weird stuff going on this year. Usually presidential election years are the best years for us as real estate agents where people are buying and selling homes. And this year was pretty good because of the economy, which was an issue all on its own. separate from the presidential election. But the presidential election itself, you got a lot of weird stuff going on with all these activists that who the hell knows what the hell they're thinking, activists or rioters or whatever the hell's going on, chasing people away from basically where they're living. Look at what's going on in New York. There's been a mass exodus from that area. I'm just talking about locally, not even all over the country, you know. But take a look at New York City alone on its own.
LA too.
People would have never thought what's going on there. You know what? I don't know if it has something to do actually with the election or if it's more, it is political in nature. And it did happen in an election year. And you usually do see things like this happen in election years, just not at the scale that the crap was going on. It seems kind of organized, you know? But that makes it difficult for us to predict the markets as real estate professionals. But either way, we're seeing that because of all that stuff that was going on, a lot of stores boarded up, closed. Plus, we also had COVID that also played an effect in the real estate market, right? In certain areas, the politicians and how they run the towns and make their decisions are making an effect. Look at New York City. Look at the restrictions that the mayor and the governor are making. You know, different restrictions for different ones. But the governor, take a look at the mayor of New York City. The restrictions that they're making, they're putting the death nail in the coffin for a lot of bars, a lot of restaurants with absurd restrictions, right? Then you also have all the rioting and stuff, smashing stores, looting and going on. The crime rates that have risen as a result of the politicians saying, ignore all this stuff because it's for political stuff, you know? So they're playing the role with each other. But how does that affect the residents? Do you want to live around that crap? People burning down buildings and robbing them and just walking up to people, sucker punching them and robbing them? You've seen news stories on this, actors in New York City, that they're all part of supporting this stuff. And they're getting knocked out on their butts, right? Imagine that you not being rich, you not being a celebrity, you not being involved in politics. You want your kids raised around that? You know, people are moving out. People didn't think that that would happen in New York City. New York City's not going to lose its value or its draw. It's a staple of the world. You go to New York City, right? Tourism, down. People just moving and living there, down. Even the people that work in New York City, where are they moving? Out of state. You got some of them, they're moving to New Jersey, and then they are traveling to New York to work. And some of them are relocating through their work, seeing that they can now work from home through Zoom and other methods like that to have their meetings and such, right? Working remotely, getting transferred to offices in, say, Florida, right? So they're going to the places like Florida and the Carolinas and moving out of these areas, you know, which ironically are things are going on that they supported. The regulations, the restrictions, the political decisions, the same people that are supporting these things are abandoning these towns. All right. Why am I talking about all this? Because it affects us as real estate agents. You have to be aware of what's going on around you and ignore all the political left and right mumbo jumbo and just look at it from the 1,000-mile view of what's really going on and be a realist. You got to be honest with yourself. I don't care what your political views are, left, right, in between. Look at the overall picture. Why is it going on? Is it going to stop? What are people's reactions going to be to it so that we get an idea of how we could predict what's going on? In New Jersey, what's going on here? I mean, we're not experiencing as much as this. We experienced a little bit of that in some of our towns, but not too many, because we're a little bit more spread out than New York City, our towns, right? But you're still seeing a little bit of that going on, but not as much. But we're seeing the COVID stuff has an effect on us, and our governor's lockdown is having effect on us. Bars are closing, restaurants can't afford to. A lot of businesses are still paying rent. Look, I'm teaching you guys remotely through Zoom, but I'm paying rent to a landlord for a building I can't even use. Luckily, I could still teach and work and teach you guys through online. What about those businesses that can't? They're SOL. You know what that means, right?
Shit out of luck.
There you go. Just wanted to know if you knew what I mean, but okay. Okay, so, but all of these factors we got to be aware of. We need to know what's going on in real estate to be able to better do our job. And they create things like housing performance timelines or maps. We call them heat maps, to tell you where people are moving to, where they're moving from. And then they talk about in the class why, so that we could kind of target our business of where we're going to market to people to buy homes or to sell homes. Because these guys at this group, they analyze all of these factors and they put it into a presentation that a lot of very large Fortune 500, Fortune 100 companies, top companies look at. And if they're looking at it, we damn well should be in the real estate market as well. Keep in mind, this is an old heat map, 2015. Okay, so they look at market conditions by county, and then when you're actually at this thing, the guy explains to you why they're heating up these areas, what's cooling off, etc. They go over a lot of factors in their reports, so I'm not going to go over all these details because this information here is old, but they give you charts like this. Well, this is an example of a CMA or an appraisal that an appraiser would do. They do something that their appraisals look very similar to our CMAs. This is a CMA analysis here, where you got a subject property for sale and comparable properties that you're going to compare it to. You're going to make adjustments for the differences. Now, see, they got a lot of different things here, the site appeal, average, cul-de-sac, that means privacy. So these are all things that affect the value. This one gets into it a little bit deep. This is actually a good one, and they give us this in an Excel format so that we could use this to price properties. And they give us an accompanying chart like this. This is the main meat and potato thing that I like going to their seminars for. And if I don't go to their seminars, I still subscribe to this and they send me these things. I got them in my recent emails. I just got to download it. Where, for example, is your house worth more or less if it's on a busy road or a private road? You see the cul-de-sac street. See over here, they make an adjustment. Where is it? On a cul-de-sac street. Okay, they're going to have to make adjustments, adding and subtracting for the differences in the housing to determine the value of the subject property that has not sold yet. These properties have already sold. So when you're trying to determine the subject property's value, well, you try to find homes that are as similar to the subject property as possible and make adjustments for the differences to try to make them the same. That if they did have the things that were the same, how much would this home have sold for? How much of a difference in price would that make? And now you get a more accurate price range that this house should sell for. That's what an appraiser does. That's what we do. Now, this chart that they give us here is really cool. It tells us a lot of, there's a lot of adjustments and a lot of different factors here that we wouldn't know how to apply a value to it unless you have experience in the business or you're doing a lot of research and aggregating data. They give us a chart here that we could simply look. If the house is in a price range of up to $250,000 and including $250,000, if the property's on a busy road, how much would that of a difference would that make in its price? And over here, they show you $10,000 if it's a $250,000 house, or 4%, minus 4%, if it's on a busy road from its value. But if it's on a private street or a quiet road, like a cul-de-sac, that adds $8,000 on a $250,000 home, or 3.2% of its value. You're going to add to the value if it's within that range. And they give these different ranges all the way across the board for all these different price ranges for homes in the 250 range, 400, 750, 1.25 million, 2.5 million and above. So this is a neat little chart in that regard, as a reference. So this is why I give you that suggestion to go to that ottawa.com, which I also have this link in the class links Word document. Situs. What are the 3 most important factors when affecting value? Location, location, and what's that other one?
Location.
There you go. I knew somebody knew it. Location, location, and location. So I believe it's pronounced situs. I like to mispronounce words to remember them. So I mispronounce this one often and I call it situs. Because once you find that perfect location where you want to live, you say, we're going to sit us right here. Okay. This is a term you need to know for exam. A people's preference for location is called
Situs.
situs. Situs or situs, whichever one will help you remember. It's pronounced situs. I call it situs because once you find that perfect location that you want, you decide we're going to sit us right here. Okay. You don't remember the story behind that. The mispronunciation is not going to help you now. All right. Now, there is a history behind this. Years ago, the United States government used to gift land. They used to give land to people. They just had to claim their territory. That's why they had that great land rush in Oklahoma. And I have that, they used to call it homesteading when they did that. And there was that scene in Far and Away, that movie with Nicole Kidman and Tom Cruise. You can look up that movie too. Has a scene in there from about that, based on that great land rush. And I got a couple of links here that show you how they actually used to, they did a race for people to race to run out to the property, and whoever could plant their numbered flag on that property, they would claim it, they'd be the first owner of it. So it was interesting the way they used to do that. All right, so we're gonna highlight in the book at the bottom of the page 274 under value, we're gonna highlight in the last paragraph there, or third paragraph, the location of a people's property and people's preference for a location is called situs or situs. Okay. And then on the next page, it says for property to have value in the real estate market, there's 4 basic economic characteristics to value. And there's an acronym there, DUST. DUST stands for demand, utility, scarcity, and transferability. In order for land to have value, there has to be a demand for it by somebody who can afford and is willing to buy it. Utility means serving a human need or desire. Scarcity means that it's limited in its supply. Transferability means that the ownership to the property is easily transferable. If any of these don't play, then it really doesn't have value. But it could be asked on an exam in this way. Which one of these 4 scenarios would apply to this situation? I'm going to buy a property, but only if the city will give me a permit to make it a combination laundromat and convenience store. Anybody?
Wait, what?
Are you guys listening? I said,
I thought you made a statement.
I was asking a question. I said, which one of these 4 economic characteristics to value would apply to this situation? I'm going to buy a property, but only if the city will give me a permit to put in a combination laundromat convenience store.
Demand.
Demand.
Utility.
Utility.
Serving a human need or desire. Okay. So the purpose of my getting the property is to want to be able to satisfy those human need or desire. They're going to need laundromats and convenience stores. All right. What is an appraisal? It's an unbiased estimate of value, or I should say an unbiased estimate or opinion of value. But that opinion is based on supportable evidence using approved methods that the appraiser uses to try to determine the value, which we'll go over those approved methods in a little while. An appraiser is the person who values the property, and appraising is a profession that requires licensing. And that appraiser is an independent person that does not work for the lender, and they do not work for the buyer, but they are paid a fee. The lender sends out the appraiser, the borrower pays the appraiser. And then that appraiser submits their report that's unbiased, because it doesn't matter their opinion from the bank or from the borrower. They get paid either way. Market value is a value that's based on the supportable evidence of recently sold properties that are similar in size, style, location, and amenity to the subject property. Well, at least that's one of the approaches to determining market value. But what is market value? It's a price that a ready, willing, and able buyer who is not forced to buy will pay a seller who is not forced to sell after the property has reasonable exposure to the market. It's been on the market for a little while. It's the most probable price that the property will bring. It's based on supportable evidence. Payment will be in cash or its equivalent, like a mortgage loan. And the buyer and seller are acting without undue pressure, meaning they don't have to sell because loss of job or relocation for job or having multiple births or other situations that would force them, they're in danger of foreclosure or any of those situations that could affect them. The forcing of the value, right? Changes. So valuation is estimated by the real estate licensee and appraisers. We do CMAs and BPOs. Appraisers do appraisals. Market value assumes an arm's length transaction. What's that mean? We're at least an arm's length apart from each other. What does that mean when I'm trying to say that? That we're arm's length transaction? It means that we're not that close to each other. We're at least an arm's length. So what am I trying to symbolize here? Well, if we look at the term arm's length transaction, it means that it's a transaction done by people who aren't that close to each other. Because if you were close to each other, like a brother and a sister, your family, right? What are the odds that you're going to give your family members a break on the price of a house if you're selling it to them? And you love them and there's no family drama.
Good odds.
Pretty good, right?
Yeah.
So you cannot use that property as a comparable when trying to determine the value of another property, because there were outside factors that affected the value of that property. Right? It's kind of like the value of a property that's sold, but it also included a car in the sale. You know, there's an outside factor there that needs to be taken into consideration. Otherwise, you're not going to be applying the proper value to the other properties because there was something else that artificially drove up the value or drove down the value. These are things that must be taken into consideration. All right. So what is an arm's length transaction you need to know for exams? It's a transaction between people who are relatively strangers to one another, each of them trying to do the best for themselves. Sellers trying to get the most money, the buyers trying to get themselves the property for the least money, right? That's an arm's length transaction. So let's go do some highlighting, shall we? We're going to highlight that under market value in the second sentence, that an appraisal is an estimate or opinion of value based on supportable evidence and approved methods. And an appraiser is an independent person trained to provide an unbiased estimate of value.
Wait, can you repeat that? Where are we highlighting?
Second sentence under market value. Second and third sentence under market value. On page 275. Then in the next paragraph, we're going to highlight that first sentence. The market value of real estate has been defined as the price that a ready, willing, and able buyer who is not forced to buy will pay a seller who's not forced to sell after the property has had reasonable exposure to the market. Wait, what if we get an offer on the first day the property's on the market? Should the seller accept it if it's a full price?
No.
Why not?
I mean, if it's full price, I guess. I don't know. I would think that they could probably get higher then.
Why?
If it's there's demand like the first day, then it's probably underpriced.
Hold on.
Okay.
I'm a real estate agent and I help you value your property. How do I help you value your property? I help you value your property based on supportable evidence of the comps that have recently sold in your neighborhood that are similar to your home. If we price the property based on the evidence of the most that the properties are selling for that are similar to yours in the area, if we get an offer, a full price offer on the first day, you're telling me you would not accept it because now you're thinking that I undervalue.
I guess we would accept it then.
I want your honest opinion. Don't change your opinion.
Well, I would just think,
because of what I say. I want to see what your thought train is, because your thought train is similar to a lot of home sellers.
yeah, I would just think, you know, something is worth what someone's willing to pay for it. So if someone's willing to pay what you're asking immediately, then maybe you underpriced it and you might want to raise it and see if you can get more. But
okay. So you're saying, oh, the offer came in too quick, so I think it's worth more.
yeah.
Well,
but I don't know.
well, hold on a second. We need to discuss it because this is a conversation we have with sellers sometimes. I've had this situation before where I listed a property spot on, perfect price. There was no other home that sold for more. I priced that home perfectly. And I put it on the market at the time that it just so happened a buyer was looking for a home in that area and liked that style of home with those features of that house and was a ready, willing, and able buyer. So in my eyes, I'm looking at it like we priced the home right and we found a buyer at the exact time. We put the time on the house on the market. A buyer who's looking for a home in the area approached us and made the offer. As far as I'm concerned, all the stars are in alignment for you. You hit the jackpot just now. But just like you, the opinion that you just had is the same opinion that a lot of home sellers have. Oh, that's too quick. We probably underpriced it. I want to get more money for my house. We need to have this discussion when you put a home on the market for sale. Because I have had properties like this I put on the market for sale. All the stars were in alignment. We got full asking price for it. And the seller thought exactly like you did. And they said, no, we're going to take it off. No, we're not going to accept this offer. All right. So what are your options? Make a higher offer ask for more money? Are you going to counter offer the full price? Hello?
I don't know.
You don't know? Well, you better know. You got a buyer here that made a full price offer. They're waiting for an answer from you.
Well, if they made a full price offer, then you kind of, I mean, you don't have to, but you should accept it, right? But the next option would be a counter, but they wouldn't feel good about you countering with a higher.
So what are you going to do, Miss Seller? What are you going to do? What are you going to do? We need an answer from you, Mrs. Seller. No pressure.
Accept it. Accept it, right?
Oh, thank you. I love you. You're a great seller. But unfortunately, my seller said, no, we think we could get more money for it. Well, how much money? How much more?
Then counter.
You know, they gave a counter offer. Buyer's like, no, boom, gone. All right, they're gone. What, are you playing games with us? Later. Agent said, why are you putting a property in the market for sale for if the seller's not willing to accept the full price offer? So I got chewed out too. Now, what does the seller do now? You think you could get more money for the house still? If this is you, I'm not chewing you out. I'm just asking you an honest question. Do you still think that you could get more money for the house?
I mean, I guess so. If I already turned down that one offer, then
okay,
I would hope so.
So then we can't continue marketing this house for sale at the current price. So what are we going to do?
Raise it.
You're going to raise the price now, right? Okay, let's raise the price and put it back on the market. And that's what we did.
Yeah.
Despite my
and then it didn't get an
vigorous
offer?
objections, that's what the owner did. And you know what happened?
They didn't get any offers?
A year later, the property's still on the market with no other offers that ever came.
That's
not a one. Let's lower the price back down. All right, let's lower the price back down. But you know what's going to happen now, right? If you don't significantly drop the price, if you're a home buyer and you're searching for a home and that home's been on the market for over a year, what's your first thought?
There's something wrong with it?
I would agree. As most buyers do, that's their first thought. What's wrong with it? See, this is why we have to try to convince homeowners of what their home is worth based on supportable evidence. And then even after we do that, if we price homes properly, but we didn't prep them and tell them, listen, I doubt it's going to happen. But if you get a full price offer on the very first day that the property goes on the market, are you prepared to accept the offer? I want an answer from you now. You have to ask them that and put them on the line. What will you do if we get a full price offer today on your property? If they say accept it, I'm going to say, let's put it on the market. If they say anything else, well, I'm going to ask them. If they say, well, why? What are the options? You know, or they say anything else. No, well, that's too soon. I'm like, then why are we listing your property for sale? Do you want to sell it or not? You got to be straightforward with people like that. If you wouldn't accept the offer, why not? If it's not because of the time, is it an issue with this price here? You know, if we do get an offer, it could be that we just priced it right and we got a buyer and we put it on the market at the right time that a buyer was looking. You know, the only time I'd be concerned about it maybe being underpriced is if we got 10 offers on the house the first day that it was on the market, full price and above. But then if we got 10 offers, aren't they going to be competing with each other and you're going to end up getting the highest offer on it anyway? And what do houses always sell for? Always. Market value. What is market value? The price a ready, willing, and able buyer who's not forced to buy will pay a seller who is not forced to sell. Boom. If you spend a little time explaining these possible scenarios and outcomes, look, it's possible that we don't get any offers on this property for a while. And if that's the case, would you say that we overpriced it and lower the price? I mean, you're prepared to say that we underpriced it and raise it. Are you prepared to say that we overpriced it and lower it?
I guess, I don't know.
Well, yeah, okay, I get the attitude, you know.
Well, I mean, I don't know. I don't know.
You know, I mean,
No.
but you know, this is our job. These conversations can be a little uncomfortable, you think, right?
When I don't know the answer.
Well, the thing is, we don't. It's a guessing game, but we're going to try to make our best educated guess based on supportable evidence. But we need to have this conversation to prep the seller. We got to let them know if we don't get offers, then be prepared to lower the price on the house. If we don't get an offer on the house in writing, it should be the first couple weeks, but at the most, the first month. If we don't get a written offer on this house, it's overpriced for the current market. For the current market. Look at markets change. Next month could be different than this month. The month after that could be different. Sometimes you get sellers, they say, well, last year, if I sold the property, I could have gotten this for it. Well, then you should have sold the house last year. That's what the market was that last year. But this year, this is the market. I'm sure if you wait 10 years from now, the market will be different. Are you ready to wait 10 more years? Or do you want to sell it now? I'm not being a wise ass. This is reality. Am I saying something that's untrue? If so, please educate me. This is just common sense stuff, right? But sometimes we got to slap people with the common sense definition and explain it to them to make it apparent that it's silly to think otherwise, to expect otherwise. Do I have all the answers? Am I absolutely definite on everything? No, but this is the situation and this is how we price properties based on supportable evidence, what they're going for right now. And this is the price, this is the current price range in this given market. If you want to wait till next year, hey, prices could go up, they could go down. I don't know. Which direction are they going in? Well, this is what the current market is. I can tell you where it's going right now. Can I guarantee that a buyer is going to buy it for this listing price? No. They may pay more, they may pay less. Best I could do is based off of the supportable evidence, right? Does that make it a little tough job to do? Yeah, sure. But it's not our decision to make. We're the professionals to give the guidance to the owner who must make that ultimate decision. And if they overprice the house, I'm going to caution them that overpricing the house could lead to the home getting stale to the market when no buyers come in to look at it or make offers on it. Look, if you underprice the house, you get a possibility where everybody's going to be rushing to your home, and now you could start a bidding war. And you know what that house is going to end up selling for is market value anyway, however much that a ready, willing, and able buyer is willing to pay. But if we underprice it intentionally, can I guarantee you that it's going to sell for market value, or it's just going to sell for the current guy who made the offer before other people got to see it? Ugh, so hard, so indecisive, right? This is our jobs, guys.
Yeah.
So market value, both buyer and seller must be well informed about the property's assets, defects, and potential. How can you properly price a property without knowing this information? How do you find out this information? Number one, go to the house. I don't know how agents get listings and they've never been to the house, they never visited it. They just listed at whatever price the seller told them. That's crazy. Have you walked to the house? How do you know there wasn't a fire in that house? Is it in good shape? Is it in bad shape? Is something going on in the town that could affect the property's value? Like they're going to be taking it from eminent domain because a project is proposed there? Or is or could the value be going up because of the economy is going to get stimulated in some way? Maybe Amazon's building a warehouse there or something. Maybe they're going to want your property. I don't know. Could be, that could increase your value. Look, I usually tell people in my town, I live in Linden. In Linden, a couple years back, they were talking about building a NASCAR racetrack. Anywhere in the United States where there's a NASCAR racetrack, those towns prosper. The towns around them prosper. I don't care if you're a NASCAR fan or not. You know, their followers, they're fanatics. They love it. They'll travel to go to a race. They'll book hotels a year in advance before a race. You know, they'll be sold out. Restaurants will be packed when races are coming to town. So what do you think it's going to do to the property values around where that track is going to be built? Now, if you're just a grumpy person, you're going to be like, all that noise is going to drive down the value. Okay, well then sell it to me cheaper because I'm going to resell that property for a lot of money, right? Because people are going to want the land around it. You know, imagine having a rental house around that area instead of a hotel for people during races. Or maybe a restaurant's going to want to buy it to tear it down and put up a commercial restaurant over there nearby, or a, you know, concession stand or something, you know? So values around those properties, they go up. And this is what happened in Linden years ago. That area that was marshland, like wetlands, flood zones. This was all around where they were going to build the racetrack. Previous useless property that nobody wanted, all of a sudden they're tripping over each other to get it, and the values were shooting up in anticipation of what was going to get built there. Now, unfortunately, the builder got all the building permits and everything was in place, except they couldn't get NASCAR to sanction one race there. And a racetrack without a NASCAR racetrack without a NASCAR race is simply a racetrack. So they scrapped that project. Okay, but in anticipation of what was going to be built, did it affect the values of the properties in the area? It did. So you got to be informed about the potential of what's going on there too. All right, real estate, the business of value. Costs relates to the past, price relates to the present, and value relates to the future. What's the last thing we highlighted? I want to make sure that we're not just jumping. Hello, what's the last thing we highlighted?
Last thing I have.
Market value assumes at arm's length transaction.
Oh, okay. Then you got that bulleted list, which goes over the rest of the points. And then underneath that, we're going to highlight arm's length transaction is one between relative strangers, each of whom is trying to do the best for themselves. And then under value versus price, over here, we just went over the difference between cost, price, and value in this little slide I put together for you. Market value is an estimate based on an analysis of comparable sales based on solid data, the evidence, based on projected sale price, the current value. So the market price in a perfect world, the market value and the market price are one and the same. The market price is the selling price. It's what the property actually sells for. So in a perfect world, the market value and the market price would be one and the same. The market value is determined by supportable evidence of recently sold similar homes based on that solid data. We could project that if you have a house and it was built the same year as the neighbor's house, and it's exactly the same as the neighbor's house, and the neighbor's house just sold for $320,000, and it's exactly the same as yours and it just sold, how much should your home sell for? You now want to put your property in the market. How much are we going to put your home on the market for now?
Same price.
It should be the same price. You don't get comps better than that. Usually we get comps that are similar in size and style and location, and then we have to make a lot of adjustments for all their differences. This house is an exact copy of yours. It should sell for the same exact amount, in theory, based on supportable evidence.
Hello?
Hello?
Hey, just seeing if this works, my mic.
It does.
Got it, thank you.
I wasn't sure if you were talking on the phone or not. Okay, to somebody else, you know. Let's see, the market price and the market value in a perfect world are one and the same, but what is the market price? It's the selling price. Market value is an estimate. And cost, well, does cost have anything to do with value? When it's new, to a point. Cost really does have little to do with the current value of the property, though. Here, let me give you an example of what a seller would say. You know how much I paid to install that? You know how much I paid to put that in? You know how much that improvement cost me? Not to be rude, but who cares? What is a buyer willing to pay for it right now? How much does that improvement increase the value of your home? A buyer does not give a crap how much you had to pay to do that improvement. Here's a little tidbit of information for you. Most improvements do not pay back 100% of what it cost the homeowner to install that improvement, unless it was a long time ago. And then those improvements may have increased in value, right? So you put an add-on on to the house, an addition on the house years ago, well, it probably cost you not as much as it does today for labor and parts, so you're probably going to get all your money back. But if you put this improvement in just a year or two ago, or so, probably spent a lot of money on it, you're not going to get all your money back. Now, let me give you an example. Look at this. Look at these improvements here. Let's look at a pool, an in-ground pool. Does it increases the value of the property? Hold on one second. Let me get that out of the way. How much does it cost to put an average size in-ground pool in?
About 20, 30,000.
All right. Think you're going to get you think it makes your house worth 20, 30,000 more?
Definitely not.
I would think not, because in a home valued up to $250,000, it's going to make your home worth $4,000 more, or 1.6% of the home's value. What? Yep. But does it make your home worth more or less, having that pool? More. Without a doubt, always more. All right. Now, if it's a house that's in a $400,000 price range, well, it would make the house worth $7,500 more, or 1.9% of the value. Up to $750,000 home, that pool would be $12,000, or 1.6% of the home's value. A $1.25 million property, that would increase it by $16,000, or 1.3%. And what is this, $2.5 million and above home, it would be worth $26,000, or 1% of that home's value. But the thing that you're also missing is that a pool in a $2.5 million is probably going to be a lot nicer than the pool in this $250,000 home. Wouldn't you agree?
Yeah.
Probably. So they probably spent significantly more than this too. They're not getting all their money back. Some improvements do not pay 100% back. What kind of improvements do pay back the most? If you're adding square footage, but probably kitchens, if they're in need of the rehab. Okay. So if you buy a house from the get-go and the kitchen it's in decrepit condition, up to a certain point, you'll get all your money back, right? up to a certain point. But if you go crazy with your kitchen makeover, we have something that we call increasing and diminishing returns. So up to a certain point, you get your return back on your money that you put in to rehab the kitchen. But if you start going extreme with your kitchen makeover, over that point, your return starts diminishing. You're never going to get that money back because you went just overboard with all the money for having the best of this and best of that. It's going to make an effect. It will make it worth more, but you're not going to get all the money back. Your return starts diminishing after a certain point. They call that increasing and diminishing returns. Okay. You guys are following me on this, right? Or you're paying attention, at least?
Yes.
Okay. So market value costs. Here's another example with cost, how it has little to do with the actual value of the property. I had a guy that did new construction. He built a brand new home, a high-end home, an expensive home, a $750,000 home. Nice listing, huh? Very nice. He put it in a $300,000 neighborhood. Think he's going to get all his money back? Having a $750,000 home in a $300,000 neighborhood?
Nope.
Do you think that people with the $750,000 price range that are shopping in that range are looking for homes in a $300,000 neighborhood?
Nope.
Nope.
They don't care how beautiful that house is. It's in a $300,000 neighborhood. They want to live in a $750,000 neighborhood. You know what I'm saying? So right there on the surface, it never pays to have the best house in the block. You'll never get all your money back. Okay. This guy had new construction. It was brand new. He wasn't able to get that 750. And he was a contractor. This was the first home he built with his own business. He worked for another home builder. He decided he's going to open his own home building business. So he found this beautiful piece of land next to a lake. And he's like, oh, it's a lakefront property. I know the $1 million neighborhood's right down the street, but instead of building this home in the $1 million neighborhood, I figure if it's on a lake, it's worth more, right? You're in a $300,000 neighborhood. The $1 million neighborhood's down the street. You should have built it down the street even without the lake. You would have gotten your money. You built that same home right here on the lake. It makes it nicer, but it's in a $300,000 neighborhood. Nobody wants that. That's going to be paying that kind of money. So the builder's first home drove him out of business when he was unable to sell it, and the bank started charging him all kinds of fines and penalties for the builder that did not sell it and pay back on the timelines. They start charging penalties, $3,000 a month penalty for not paying the loan back, and on, until he then had to lower the price aggressively. And it still wasn't enough. He ended up getting foreclosed on by the bank. His first home that he built drove him out of business because of a bad decision he made. You tell me it doesn't make a difference. All right, basic principles of value, the highest and best use. Turn the page. Oh, wait. Before you turn the page, under value versus price, I want you guys to highlight market price. On the other hand, is what a property actually sells for. It's the selling price. And then under market value versus cost in the second paragraph, the first line, I want you to highlight, instead of highlighting the first word there more often, I just want you to highlight often, cost does not equal market value. Then you turn the page. Now we're going to be going over a bunch of the basic principles of value, a lot of the theory that appraisers take into consideration, and we as real estate agents do. Here's one of the things, this term you need to know for exams, highest and best use. What is the highest and best use? It's the most profitable use that a property can be adapted to, or a use that'll be most in demand in the reasonably near future. That is the property's highest and best use. It'll come into play again when we try to value homes later or properties later, using the 3 approaches to value that we're going to learn. So we're going to highlight that in the book, the first sentence under highest and best use. Then go to substitution. Oh, by the way, since we're here under highest and best use, an amenity, the term amenity, you see that term amenity there? An amenity is a tangible or intangible benefit to the property. Let's highlight that. An amenity could be something like a gorgeous ocean view at the beach. Can that affect your property's value?
Yeah.
Okay. Would having a swimming pool be an amenity? Or a
Yes.
jacuzzi?
Yes.
These are all amenities. These are extras that do add value to the property. They could be tangible, like a swimming pool or a hot tub, jacuzzi, or it can simply be a beautiful view. That's intangible, the view, but it still can add value, right? Right. So substitution. The theory of substitution, we're going to highlight the principle of substitution states that the maximum value of a property tends to be set by the cost of purchasing another equally desirable property. They go on to say, for example, if 2 similar homes sell in an area, generally the less expensive one sells first. Why? Because nobody will pay more when the same can be had for less. If you got 2 homes, they're exactly the same, which one would you buy? The cheaper one, right? If there's no differences in them. Or am I wrong? If I'm wrong,
Right.
I want to sell you a home. All right, here's a theory of substitution on this slide I put together, comparison, where you can get that visualization. If there's 3 homes on the market for sale, 300,000, 305, and one for 310, which one would you buy? They're exactly the same in size, style, location, and amenity. Which one would you buy? The cheapest one first, right?
Yeah.
But you know what? Somebody beat you to it. Now, which one would you buy? The next cheapest one, but somebody beat you to it again. Now, which one would you buy? The only one left, right? But obviously now this is a situation of supply and demand. This home is probably going to sell for significantly more than this price because the demand is obviously there and the supply is dwindling. That is a visualization and example of supply and demand now. Okay. So we showed you that progression from substitution to supply and demand.
But can you negotiate down? Well, I mean, of course you can. It's about negotiation.
Why would the seller negotiate down when you've got people that are eating up these homes quicker than you could make an offer on them?
They wouldn't.
I know you as the buyer want to get it as cheap as possible, but the seller wants to get as much money as they can. And if the demand is there and it remains constant, but the supply is dwindling, that's the theory of supply and demand, right? Now we got us a bidding war. You're like, oh, that sucks as a buyer. The seller's like, awesome, awesome sauce. All right, so what are some of the basic principles of value, supply and demand, okay? The value of the property increases if the supply decreases and the demand increases or remains constant and vice versa. That's the theory of supply and demand, which we have already highlighted here, right? Now, conformity. If something is conforming to the neighborhood, what does that mean? It fits in. It's similar, right? Or same. We learned about in condominium complexes, they want things to remain uniform or conforming to the neighborhood. Why? If anybody's talking, you're on mute because I can't hear you.
To fit in with the homeowners association, like with their guidelines or whatever.
Well, their guidelines
more
are
appealing,
set up that they want to keep it conforming, but why?
to make it more appealing, like looking, and the value will reflect
Wait,
that.
what's that last thing you said?
The value will reflect that.
It maintains the value better
Yeah.
if something is conforming to the neighborhood.
Yeah.
All right. If it's not conforming to the neighborhood, the value doesn't maintain as well. For instance, remember I showed you this morning, I showed you about that guy who built the house around the corner from my house using that 203K loan, and they built this house. It's like 3 times the size of the homes around it.
Mhm.
It's a beautiful house. It's going to be worth a lot more money than the other homes, right?
Mhm.
You think he's going to get back all the money that he put into it though?
No.
Probably not. Probably not. When it comes time to sell, it never pays to have the biggest and the best house on the block. You're not going to get all your money back. So that house is definitely non-conforming to the neighborhood. I mean, it's conforming to the neighborhood in the regards that it's a one-family house, but it's 3 times the size of everything else. Okay, so non-conforming structures don't maintain value as well in the neighborhood. Let's go over the theory of regression and progression. Regression, if all the neighborhoods around you are either, the homeowners are not, all the homes in the neighborhood around you are not being maintained, or people are getting foreclosed on and the homes are getting boarded up, what's that going to do to the value of your home?
Bring it down.
Their homes are going to affect the value of yours?
Yeah, it's going to bring it down.
Yeah, it's going to bring it down.
Yeah.
Okay, they call this regression. The neighborhood is regressing. It's going downhill. You ever hear that? People say, oh, that neighborhood's going downhill, right?
Yeah.
Boom, there you go. That's regression. But the opposite is possible. If everybody around you is building up, like that one guy who built up that house, what if his neighbors around him start doing the same thing? What's that going to do to the values?
Bring it up.
Drive them up.
It's going to drive them up. Even for the homeowners who are not doing improvements to their houses. You know why?
Because the neighborhood getting better around them.
Yes. Here, let me give you a little saying. If you've never heard this before, let me give you this saying. All ships rise with the tide, right?
Right.
All ships rise with the rising waters, raise all ships. So if these homes around you start building up, they're going to start raising the value of the neighborhood. That's going to be a neighborhood that people are going to want to move to. I seen neighborhoods like this in Edison, where it was like old ranch houses and dilapidated homes, but builders started buying up these nice properties because it was in a good area though. And they started putting these multi-million-dollar homes in it. What do you think it did to those shacks, those old farmer homes that are still in that neighborhood? They had people knocking
more valuable.
They had people knocking on their door every day, giving them business cards, making them offers to buy their home. Did you know your home could be worth a lot more? Guy's sitting on his front porch. Yep, I know. He's just rocking away. I know, every day you're like the 10th guy. Every day I get offers. He's just watching the values rise because people are building up around him and he's not doing a damn thing to his house and his values are going up. All right. That's progression. In anticipation, I told you the story already about the NASCAR racetrack. In anticipation of it getting built, did that have an effect on the values in the neighborhood?
Yeah.
Yep. Anticipation is something else that could, you hear something's going to happen. The Ford plant is going to be shutting down soon where everybody got their jobs. Is that going to have an effect on the neighborhood?
Yeah.
Yeah, it's not going to be a positive one though.
Not at all.
Regression.
That's regression. But in anticipation of that, you could try to sell your home and beat it, you know. But we could see the writing on the wall sometimes. But if you hold out long enough, could it turn around? Yes, because that very thing did happen in Edison. Did you know Edison used to have a Ford plant on Route 1? It's now Sam's Club, right? And now they're going to be building up other things over there. They got the Sam's Club, the Top Golf, all that stuff over there, and all those undeveloped areas still. That's all still to be developed. It was just it's taken longer than anticipated to build it up because of a lot of factors in economy over the last couple of years. But that all used to be the Ford plant. In Linden, we used to have the General Motors plant that shut down. It was sitting there vacant for years, had an effect on a lot of property values because a lot of people had their jobs. They, the families that worked there, you know, and eventually they sold it. A lot of different parties, they sold it. You had Blue Ribbon put up or Blue Apron put up a factory there. You know what Blue Apron is? Those people that make the home cooked meals and then they deliver them daily to people's homes in frozen things. They're healthy meals that you could order, that you could just cook up now, reheat, you know.
Yeah.
You could order them online and stuff. They have one of those factories over there where they cook stuff all the time. You have a CNC cola plant that got built up on one of the properties. You have some kind of medical transportation company there. You have I don't know what's one of those ones with those the furniture and all kinds of good and all kinds of other goods that you could get at good prices. Wayfair built a distribution center there, and now you have a super Walmart that was just built there. And now I see that they're building some other things. I don't know what else is going in over there, but they're building some other stuff now there too. There's plenty of land over there for them to do it. So that's starting to build up the community a little bit. Is that going to have an effect on values?
What does that do to the taxes?
Well, you would think that it would lower the taxes or at least prevent them from going up because all the additional revenue that or tax dollars that improving those lands would do, right? It depends on the management of the town. How's the mayor and city council? What are they doing with that money? Are they spending that money like it's going out of style, or are they actually going to be pursers of the money for the citizens that live there and actually use that additional revenue to bring down their taxes?
Right, because I was once told that that's why Roselle's taxes are so high, because they don't have any major corporations over there.
Roselle got a lot of industry. They chase them out though with those taxes.
Right.
You know, like Roselle got the first, they got that one first place, Romanovsky, that one building, as soon as you go over the very steep train bridge, there's a building.
Oh, yeah.
There's a building right there. That building right there, it's a warehouse. You could see it's like an old, it got clothes in it or something like that. It's a kind of textile company or something.
I think it's on South Ave.
That building is historic. You know what happened there?
No.
The first ever radio transmission came out of there.
Oh.
Okay, so there you go. We got a lot of, New Jersey's famous for a lot of stuff. Hell, with all these Thomas Edison laboratories everywhere too, you know. A lot of things happen in New Jersey. Okay, so here's some more basic principles of value. We have the increasing and diminishing returns, which I already explained to you guys about, you know, you could do the improvement on your kitchen, but up to a certain point, you'll get your money back, but you start going overboard, your return starts diminishing. And I'll give you an example here. Not everybody needs a $100 bottle wine cooler in their kitchen. You know, I know I get some ladies that argue with me on this point in the class, but you know, they like to get their drink on. That's okay. But you're not going to get all your money back on that. Contribution, how one person spends money. I mean, you could give two people $10,000, or we could give two people $20,000 to do improvements to two houses. You've even seen stuff like this on HGTV. And who's going to raise the value of the home more based on how they use that money? That's basically what the contribution theory is, how the money is being utilized, not just that you use money. Competition, can competition affect the value of properties? Absolutely. Profits attract competition. But if you have excess profits, they could attract ruinous competition to the area. Look, if there's only a McDonald's in the area, what do you think is going to get built there pretty soon?
Burger King? Taco Bell?
Burger King. They're always building one right next door. And then a Taco Bell, maybe a Five Guys or a Smash Burger or something, right? Uh-oh, now we have ruinous competition. Now we got so many places moving in for that business because they see that there was an opening and a need for all that other places to eat during the lunchtime or what have you, that it attracted ruinous competition. And that's bad for business, at least for the commercial properties, right? Commercial properties are valued based on their income. All right, change, that could affect value. Nothing remains constant. We have changes in local market conditions when plants shut down or industry moves in. So the jobs could affect it. The local job market can affect it, or pandemics, you know, shutting down stuff could affect the values of properties, right? Politics, the politics we talked about New York and the political decisions that they've made to keep businesses shut down or to allow rioting and looting to go on without law enforcement. You know, it chases people out of the area. You know, you could have your political opinions, but in reality, you don't want your family living close to that crap. So it chases people out of town. So it does have an effect. Improvements, people do improvements to the area. Well, that's a town that I want to move into, one that's up and coming. I don't want to move to one that's going down the tubes, right? Things like contamination could affect the value. Industry, weather, flood zones. Can flood zones affect the value if the property's in a flood zone or not?
Yeah.
Yeah, now you got to get flood insurance. That's an additional expense. And plus, who wants to live in a flood zone, right? So there's a lot of factors that play into that. And sometimes they do remapping of the flood zones and their remapping, all right? So weather changes in weather patterns and flood zones, all of these things can affect the values of property. And so, see, it's not always just about the house itself. It could be other factors that play a role to the values of properties in an area. We getting too deep for you?
No.
All right, good. So there are 3 approaches to value. Highlight at the bottom of the next page, the title, 3 approaches to value. And then we're going to highlight on the second line, the sales comparison approach, the comparison approach, the cost approach, and the income approach to value. Let's highlight all 3 of those. Okay. Now, let's go over those 3 approaches to value. First of all, let's just stay on this slide for 1 second. You need to know these 3 approaches to value. Study them. You must know. What are the 3 approaches to value? Sales comparison approach, the cost approach, and the income approach. And you need to know the details, what each one is. That's what we're going to go over here. The first one, the sales comparison approach, also known as the comparative approach or sales comparison approach or price comparison approach to value. How does it determine value? Well, first of all, let's learn this. It's the approach to value that's most often used by real estate practitioners, real estate licensees. I give you the example, take that CMA workshop to learn about them. It's best used for residential valuations, residential properties. It compares the subject property to similar ones using comps that are similar in size, style, location, and amenity. What's an amenity?
Like a pool or jacuzzi, tangible.
Some kind of addition to the property that could be intangible too, like the views, right? That some kind of a bonus to the property that makes it worth more or more desirable, okay? So we look for properties that are similar in size, style, location, and amenity to the subject property that has recently sold. And then we'll make adjustments for the differences to come up with the price range. So we're going to make adjustments in the sales price of the comps for various differences. You're going to adjust for the date of sale. First of all, you shouldn't look for comps further back than 3 months, but if there aren't any, then you may go back up to 6 months. If you start going a year or more, you have to start making adjustments for market change too, which then the math starts getting a little more complicated. Location has to be relatively the same, always has to be in the same municipality. You don't compare the prices of comparables from different towns. They're different taxes, different school, different policing, different bonuses to them and different downfalls to each, right? So you got to make sure the comps that you're comparing apples to apples here, make sure it's in the same town. Its physical features should be similar. If not, you're going to make adjustments for the differences, whether it's the size or the condition. Terms and conditions of the property of the sale have to be known or should be known. You know, were there factors that we need to take into consideration, like did the seller pay the closing cost on this? Did the house come with a car or something that affected the value, you know, had some kind of effect in the value? Was it to a family member? You know, some of these things, they could be difficult, if not impossible for us to find out, so we may never know. If a subject property has a feature on it that's better than the comparable property or worse, we're going to have to make adjustments for those differences. And now what I'm going to teach you is how to know when do you add and when do you subtract from a comparable's value to determine the differences value. Well, the book manufacturer on the next page, there's a chart. You see the chart on page 279? There's a CMA chart, sales comparison chart, has 3 comparable properties. You got a subject property and 3 comparable properties here. Don't worry, I'm going to have a next slide. I'm going to have that on here too. It's going to be coming. See that? Boom. We're going to be going there in a second. But at first, I just want to explain to you first, when do you add and when do you subtract from the comparable's value? What is a comparable, first of all?
A property that's like the one that you're appraising?
Well,
and similar,
okay.
Have similar.
The property we're trying to determine a value for, we call it the subject property.
The subject property.
Okay, it's the subject of our conversation, which is trying to determine the value. So we always refer to it as the subject property.
Okay.
So a comparable would be those properties that are similar to the subject property. We call them comps for short, but they're comparable. They're very similar properties. It's easier to find properties that are similar and make adjustments for the differences than to find properties that are way different to begin with, and then have to try to determine a value differentiation for the differences of the property, and then for the condition and features as well. That makes it a little bit more difficult to determine the value that way. So we try to find homes that are similar, at least in style first, right? You want to compare a Cape Cod to a Cape Cod or a split level to a split level, right? And then you can make the adjustments just for the condition, for the size, for upgrades, or, you know, location or things like that, right? Now,
Right.
when do you add to or when do you subtract from a comparable's value? They give you a complicated way to try to remember this that's written in the note under that guide, under that CMA there. They tell you that if a subject property is missing a feature or is in poorer condition than the comparable property, you're going to add to the value of the comparable. They call that CBS, comparable better subtract. If the subject property has a feature or is better condition than the comparable, you're going to add to the value of the comparable. CPA, comparable, poorer, add. To me, that's confusing as hell. If you guys understand that, good for you. You want me to teach you an easier way to remember it?
Please.
I'm a visual person. I don't know about you guys. Okay. I'm a visual person. So if we go to this next, chart here, so we see the chart. This is like the chart that you have in the book. You have your subject property. That's the property you're trying to determine the value for. And we have at least 3 comparable properties you should have when determining the value. So if the subject property has 4 bedrooms, it's a Cape Cod style house and all these comparables are Cape Cods. If the subject property has 4 bedrooms, and we see that this comparable one only has 3 bedrooms. We're gonna have to first determine what the value of a bedroom is. And then we're gonna have to add or subtract that value for a bedroom to the sale price that we already know. What we're trying to do is to say that if this house, this comparables, had the same exact features as the subject property, what would it have sold for? Because right now, with its current, the way its current condition is, it sold for $300,000. But it only had 3 bedrooms and the subject property had 4. If the only difference to the house was the number of bedrooms, and if we know that 1 bedroom is valued at $5,000, how much more would this house have sold for if that was the only difference? $5,000 more, because we're going to pretend it has 4 bedrooms, just like the subject property, to give it a better price range, right? By trying to put this home on the same level. So basically what we're doing is we're getting homes that are similar and we're going to make adjustments for the differences. Now, how do you determine how much a bedroom is worth and how much a half bath is worth and all that? Well, either experience or by taking that CMA class, like I told you, and getting a thing like this that'll tell you. Okay? So experience or taking a class. Right now, don't worry about that. They're going to give it to you on exams. They're going to tell you. The part that you need to understand is when do you add to and when do you subtract from a comparables value. So here it is. I made these 2 little things up here, okay? We got the subject property and the comparable property. If the subject property has 4 bedrooms and a comparable property only has 3, it's missing a feature the subject property has. It's not at the same level, right? We dropped it down. It's not at the same level. It only has 3 bedrooms. Subject property has 4, right?
Right.
So if we determine whatever the value of a bedroom is, who cares what that value is? Are we going to have to add to its value to bring it to the same level of the subject property or subtract?
Add it.
You add, it brings it up.
Mhm.
If you subtract, it would have brought it down.
Brought it down.
Right? So this is the visual here. If you don't have these things in front of you like that, you could do this with your hands while taking the exam. You could be like this. Subject property has 4 bedrooms. Comparable property only has 3. That's less. So whatever the value of the bedroom is, I'm going to add to its value to make it the same, to bring it to the same level. That's our goal, is to take the comparables and make them the same when trying to determine the value. Does that make it a lot easier to understand when you're doing this, trying to make it to the same level?
Yeah.
Okay, so here, let's ask this in a different way. If the subject if the subject property had 4 bedrooms and the comparable property had 5 bedrooms, are we going to add or subtract from the comparable's value to make it the same?
Subtract.
It seems easy to you.
Well, it's addition and subtraction.
Yeah, but it's a matter of knowing when to add and when to subtract. Is the visual helping?
Yes.
That makes it so much easier, doesn't it? I'm a visual person. That CBS, CPA bullshit, that don't help me at all. That confuses the hell out of me, and it's just something else to remember. God, you need something else to remember now? Yeah. I just do it like this. You could use these things, or actually you can't take these 2 exams, but I could use this to explain it to you at the beginning. And then I could go like this with my hands. Subject property, comparable property. We want them to be exactly the same. Let's say we're talking about the number of bathrooms now, as you see the chart on front of you. The subject property has 2.5 baths. The comparable one property only has 2 baths. So it's at a lower level, right?
Right.
So what do we do to bring it up to the same level? We're going to have to, whatever the value of a half bath is, we're going to have to add or subtract to its value.
Add.
Boom. And if it had more baths than the subject property, are we going to have to add or subtract from its value?
Subtract.
Pretty easy, right?
Mm-hmm.
Okay. Now, the hard part in the real world is knowing how much to apply to it, but I don't want you guys to worry about that right now. Right now, I want you guys to just understand, to have the basic understanding. When do you add to and when do you subtract from the comparables value? You're never going to, yeah, you're never making
this sticks.
Yeah, because you're never making adjustments to the subject property's value because you don't have a value for it yet.
Mm-hmm.
It didn't sell. Only the comparables sold. So you're going to have to place a value to the comparables differences and make the adjustments. Subject property, you never make adjustments on. The comparable properties you do to try to determine what the value is for the subject property. Make sense?
It always makes sense in class.
Thank you. That means I'm doing my job.
Right.
Now it's a matter to remember it. And that's no small feat. There's a lot of stuff I'm telling you to remember here for the last 2 weeks.
Right.
You know, it's not, it's nothing to sneeze at. You know, I understand that you guys are learning a lot of information right now. You know, what did I tell you at the first day of class? It's like learning a new language in 75 hours. That ain't easy. And isn't that what you guys are doing? You're learning a lot of terms and definitions mostly. I mean, we're learning some concepts too and some math, but most of it is terminology. All right, so right now for the sales comparison approach, that's all you need to know. When do you add, when do you subtract to a comparable's value? And if you keep doing that for all the differences between all the comps, see, you add some areas and other areas you subtract. Why do we subtract from this one? Well, comparable 3 property had 2 garage spaces and the subject property only had 1. So it has, the comparable property has a feature that the subject property is missing, an extra garage. So we subtract from its value to bring it down to the same level, the value of that additional thing to the garage, the additional garage. Okay. Now, on exams, if they give you something like this, they'll tell you you're trying to value the subject property and here's the features of it, and there's comparable properties and here's what their features are and what those features are valued at. So basically, you're going to have to draw a chart like this on scrap paper and then do the addition and subtraction to give the price that that house should sell for. But like you said, it's basic addition and subtraction. You're just going to need to go, when do I add? When do I subtract? Because the job is to try to make the comparable the same as the subject. And when you would make the adjustments for all those differences, you add up all the differences, like see all these things are different for comparable one. 5,000 here, 2,500, another 10,000. That adds up to $17,500 in differences. That's the total adjustments. And it sold for $300,000. If this house was exactly like the subject property, it would have sold for $317,500. This comparable property too, it had the same amount of bedrooms, same amount of well, it had a half bath less, but a half bath less is valued at $2,500. So we're gonna have to add $2,500 to its value, and that's apparently the only difference. Then that means that this house should have sold for $317,500 as well. We're starting to get a picture here of the price range that this house should go for, right? Now, a comparable 3 sold for $320,000. It had 4 bedrooms, 2.5 baths, just like the subject, but it had an extra garage. That extra garage is valued at $10,000. If you subtract that $10,000 for that extra garage space, it would have sold for $10,000 less because that's the only difference. That means this house would have sold for $310,000. So now what's our price range for this house? Between $310,000 and $317,500. That's how you price. And now whose decision, who determines what the asking price of that house is going to be?
Appraiser.
What? Who determines what the listing price, the asking price for this property is going to be?
The seller.
It's their property. We're just putting together this adjustment to show them this presentation that we call a comparative market analysis, to try to show them how we determine the price range for them based on supportable evidence of recently sold homes. And we made adjustments for the differences, and this is the price range for your home. This is the same thing that an appraiser is going to do, only we're not going to call this an appraisal. It's a CMA. We can't call it an appraisal because we're not licensed appraisers, a profession that requires licensing. All right, so which approach this approach to value, sales comparison approach, we use it for what? For pricing what? For pricing what? For pricing what?
Comparison houses.
What kind? Oh, houses. What kind of house? What kind of real estate's that?
Residential.
There we go. So it's most often used for valuing residential properties. It could be used for commercial too, but it's most often used for residential. And so let's go over the next approach to value. Well, before we do, real estate, the business of value, costs relates to the past again, price relates to the present, and value relates to the future. So in a sales comparison approach, a lot of times after we went through all of this work to determine what the price range should be, you're like, wow, I did all this work. I learned how to do this. I priced this home properly. This is what the price range is. So let the homeowner now listen to my genius and price this home right so we could sell it and make some money, right? That's what you're thinking now, right? Our job ain't that easy. You telling the homeowner their home is worth this. They're like, well, you know what? I want this for it. As dictated by this picture, as indicated by this picture. The homeowner thinks that they got the castle here. You're trying to talk them down to reality based on your supportable evidence. But the appraiser knows how to value homes better than you, and they're down here. Which is the only one that matters. Well, because most people aren't buying cash, so they need to get a loan. And the appraiser's determination of how much that home is worth is going to be weighed heavily by any lender that's going to loan a buyer money to buy this castle of theirs. And the appraiser says your castle is more like a mud hut. And the homeowner's like, that's insulting. And you're like, okay, well, help me out here. If you think your home is worth here, why do you think your home is worth more than this valuation? Have you done any improvements to that home? Is your home different than the others that the appraiser compared it to? Why do you feel like your home is worth more? Let them talk to you. If they start saying nonsense like, because that's how much money I needs to get, or that's how much money I want, I'll reply, do you think a buyer really cares how much money you needs to get or how much money you want? Or do they base their pricing based on the value of the home, based on what homes are going for in the area? If you're going to be buying a new home when you sell this one, how are you going to want to base your offer on that home? I'm sure you're going to try to get it as cheap as possible, right? But you're going to be, homes go for market value. So whatever homes are going for in the area, you got to base the value on that. We got to be fair to everybody. So even though I know you love your home and you have a lot of, pride in your home ain't worth that. It's worth this, based on the supportable evidence of what buyers have been willing to pay for homes in this neighborhood recently that are similar to yours. And if you cannot talk that seller down to reality, you want me to give you a little game that you could play with them, perhaps, to try to get them into reality before you waste months on end on marketing a property and listing it overpriced?
Sure.
Take them out and show them some homes in their area that are similar to those, and have them guess the price, the asking price on them. And then show them the details on the property, the features of the property, what the actual listing price is after they guessed. And then show them if the property, well, if it's still on the market, show them how long it's been on the market. Was that house successful in selling yet? No, they're still a failure. So do you want to be a failure like this guy trying to sell his house, or do you want your home to be sold? You're going to have to price it accordingly. If you price your house just like this guy does, your house is going to sit. I call this the Price is Right game, right? And sometimes the price is wrong, Bob, right? When you make them guess on the value of the home, and then you show them what the asking prices are, it's not even the value. We're just guessing on what these other home sellers are asking, and then showing them that they failed to sell. Say, I just want to show you something. You mind coming out and seeing a few homes with me in the area that are similar to yours? I want you to show you what they're going for, okay? Or at least what they're asking for them. And then if there's getting any offers on them or anything, okay? Unfortunately, you're probably not going to be able to take them out and show them homes that actually sold unless they're your company's listings, and you can maybe get them in there. But try to play that Price is Right game a little bit. All right, let's look at the cost approach. Cost approach to value. We know the cost has little to do with value, but it does have some to do with value. Now, the cost approach to value is sometimes referred to as the appraisal by summation. You need to know that for exams. Cost approach is sometimes referred to the appraisal by summation. And it's based on substitution, the theory of substitution, that nobody will pay more when the same can be had for less. What am I talking about? Well, the cost approach to value is used to determine the value of special purpose or unique or one-of-a-kind properties or public properties that may not have comparables or generate income in the normal fashion, like schools, churches, libraries, or city hall, or maybe a custom or unique home. How do you determine the value of them? Well, the cost approach to value, what they do is they first see, here's the process. These are the steps that the appraiser does. We as real estate agents will never use this approach to value. We simply don't have the knowledge to do it. But we do have to get a math problem for exams on it. But this is always done by appraisers. So how does an appraiser determine the value of a property using the cost approach? Well, first they estimate the value of the land. How much would it cost to buy that? Let's say that the church, there's a church for sale in the neighborhood. Are there a lot of comparable properties in the neighborhood of churches that have recently sold? Probably not. And churches don't generate income like most income producing properties. So we would use the cost approach to determine the value of this property. In order to do that, we got to see how much would it cost to acquire that land that that church is sitting on in this neighborhood today if it was put to its highest and best use? And what's the highest and best use for that property in this neighborhood? Right? Because what is the highest and best use? The most profitable use or the most valuable use that a property can be adapted to, or a use that's most in demand in a reasonably near future. So how much would it cost to buy that land, just the land? Then they got to estimate the current cost to construct all the improvements to the property. You know, to put in the water and the sewer mains and the gas pipes and build the structure. And there's two approaches that the appraiser can use for constructing the building. We got something called replacement and reproduction costs. There's two approaches. Your insurance companies would have an appraiser use one of these approaches too, depending on the type of policies that you have. On this slide, the next slide here, I talk about the reproduction versus the replacement costs, okay? But before I get into the details of that, let me just explain it in a different way that's non-real estate related. You guys paying attention, listening?
Yes, yes.
Yes.
Okay, okay. So let me start by asking this. I know it's totally non-related. It's not meaning to offend anybody. Forget my shirt right here for a moment. It's not meaning to offend anybody. I'm just trying to teach with a little bit of humor for ways for people to remember stuff. I'm showing you a couple ways to remember. Ladies, why do you have children? To make little miniature, mini-me, duplicate, exact copies of yourself. What do we call it when you have children? Reproduction, right?
Right.
So reproduction is making an exact copy.
Right.
Can you still have a child without reproducing?
Adoption.
You could adopt, right?
Right.
And you still have the same effect. You have a child that you could raise as your own and grow up. It's just not going to be an exact duplicate of you.
Right.
You guys getting a picture in your head now what the difference is between reproduction and replacement? Replacement is replacing it with something that's similar, but not exactly the same. Reproduction is making an exact duplicate. And pretty much that's what I show you on this slide. Reproduction is an exact, which by the way, I didn't mean to offend anybody that's adopted or anything like that. Just try to point to you a picture. There's a way that you could still have a child and not have a baby, you know, not to reproduce yourself. Okay, but that shows you reproduction is an exact duplicate using today's materials, the same materials that were used on that property. For instance, if you have a high-end kitchen and you have a fire in your house, you want to make an insurance claim on your insurance policy, is the insurance company going to replace it with all the high-end countertops and sinks? And if you had Viking appliances, they're going to put in those high-end Viking appliances again? Or are they just going to replace it with something else that's functional, that serves the same purpose, that's not necessarily an exact duplicate, which would be replacement costs?
Mm-hmm.
Saves the same purpose. You got a refrigerator that's a GE White product. It still cools your food, right? but it's not an exact duplicate. This is important because look, when you have insurance on your house, do you know if you have an insurance policy that's replacement cost or reproduction cost in the event that you have a fire? Well, I'll tell you what, if you have high-end stuff in your house, you better make sure that you get that reproduction cost policy. The insurance will cost you a little bit more, but if you have a fire in the house, it's going to replace it exactly with what you had before. If you only have a replacement cost policy, they're going to replace it with some off-the-shelf Home Depot basic cabinetry, some vinyl countertops. Hey, you can still prepare your food on it. It's functional. It's just not an exact duplicate. They'll give you a sink that works. You could run water and clean your dishes in it. It's just not going to be an exact duplicate as the higher end stuff, right? You could have a white product refrigerator that's going to keep your food cool, but it's not a Viking brand one, right? But if you want to replace everything exactly the way it was, you want that reproduction policy. Okay. So when an appraiser is using the cost approach to value, there's two methods that they could use to determine those costs to construct. So they're going to have to determine which method that they're going to use. Then they would estimate accrued depreciation of the improvement. What is depreciation? Depreciation is a loss of value due to any cause or condition. The property depreciated in value, all right? Why? There's different kinds of depreciation we're going to learn about. Actually, you know what? I'm going to go to another slide, the next slide over here. The cost approach is based on substitution. The word depreciation is a loss of value due to any cause or condition to the improvements, not to the land, because land does not depreciate, right? Except for in extreme circumstances, if it's contaminated or something. Now, if we turn the page, 281. For depreciation, let's highlight depreciation refers to a loss of value due to any cause or any condition that adversely affects the value of an improvement to the real estate. And then you're going to underline, as a general rule, land does not depreciate. Now, there's three forms of depreciation or depreciation we need to be aware of. One is physical deterioration. Can that be cured? You know, a house is just falling apart. It's getting eaten by termites, or just age, it's rotting. Can you replace the wood? Can you fix that?
Yes.
Yes, it's curable then. The problem's curable. All right, but that one's kind of obvious to figure out. These next ones are maybe not so obvious, but these are terms that you will get on exam and you must know. Functional obsolescence. Do not look at the definition. Just look at the words. Functional obsolescence. Let me mute that. Somebody's talking in the background. So if a property is functionally obsolete, what does functional mean?
Working.
It's working. And what does obsolete mean? It means it's outdated.
Right. Not the, okay.
Can something be in perfectly good working order? There's nothing wrong with it. It's just outdated, no longer considered desirable by buyers in the current market.
Yeah.
Yeah. So functional obsolescence. It means that there's no problems with the house. It's just outdated. Let me give you some examples. Well, if something is obsolete, functionally obsolete, can it be fixed? If a house is outdated, look, if a house is outdated, oh, this kitchen is outdated. Can
Yes.
Can it be fixed? Sure, it can be fixed. Absolutely. All right. Let me give you an example of functional obsolescence. A 5-bedroom, 1-bathroom home. Is that functionally obsolete?
Yes. It's a yes.
Yes, by today's standards, most people are getting a 2-bedroom condo and they want 2.5 baths, right?
Mhm.
Right.
So can they fix that problem? Can they add another bath?
Most
Yeah.
likely.
Most likely, probably, yes. All right, so it's curable. But is there anything wrong with that bathroom?
No.
No, they could have a large bathroom that's just been remodeled. It's all updated, but it's just still 1 bath. By today's standards, 5 bedrooms and 1 bath, right? So that house is suffering from functional obsolescence. Now, external obsolescence, what does external mean?
Outside.
Outside. So it's something that's not on the subject property. It's not outside the house. It's not even on the property. Something that's external is something that's not on the subject property that affects the property's value or desirability. Sometimes external obsolescence is referred to as economic obsolescence or locational obsolescence. The local economy, the major place where people have all their jobs, is shutting down. That's economic obsolescence. It's something it's a factor. It's not on the subject property, but it affects the value of the subject property. The major industry is moving out of town. So the local economy is having an effect on your value of your property, right? Right?
Right.
Okay. Now, locational obsolescence. Location, location, location.
Mhm.
You have a nice, beautiful little park next door to your house. It's really nice. Oh, they just found out it's contaminated with PCBs. Is that going to affect your property's value if the park next door to your house is contaminated?
Yes.
Yes.
Can you fix that problem?
No.
You can't, but
You
somebody
can.
else might.
It's not on your property. So for that reason, it's usually incurable. Not always, but usually incurable, because you have no control of things that are not on your property. So your property is suffering from external obsolescence, and this type of obsolescence is almost always incurable. So you do need to know what functional obsolescence is and external obsolescence, sometimes called economic or locational obsolescence. And you need to know that external obsolescence is almost always incurable. So another good slide to study from, brought to you by yours truly. So we're going to highlight physical deterioration. Actually, no, don't highlight that. Highlight functional obsolescence in the book. This refers to functional or physical or design features that are no longer considered desirable by property buyers. And then highlight the word curable right next to, underneath it. And then go to external obsolescence and highlight the first 2 lines there. External obsolescence, also known as economic or locational obsolescence, is caused by factors not on the subject property. So this type of obsolescence is almost always incurable. Now, back it up to page 279 for a second. We're going to highlight something and we're going to call it a day. Highlight the cost approach to value is most helpful for the appraisal of special purpose buildings such as schools, churches, and other public buildings. And then in a paragraph beneath it, the last sentence, the cost approach is sometimes called the appraisal by summation. And the cost approach consists of 5 steps. And here's the following 5 steps beneath it, which are continued onto the next page. And those are Those are these steps right here. And that's what slide number is that? Slide 24. Chapter 16. And 4:39. So we shall put out the afternoon poll and call it a day. Boom.
Thank you.
You're welcome, all.
Thank you.
Thank
All right,
you.
have a
See you
good night.
tomorrow.
All right, you're welcome, everybody. See you tomorrow morning. We'll finish up this chapter, then we'll do
Thank
the
you.
math. There's a lot of math in this chapter. So, but we'll first finish off the terminology and the one more approach to value after this.
Okay.
All right.
Great, thank you.
See y'all tomorrow.